Let's get to those numbers. Right now, Dan Newman, I'll bring them to you. We have Nvidia. Let's start with the bottom line here. Adjusted EPS 105. I do not have a clean compare yet on the bottom line, but the top line, Q2 revenue, $46.7 billion. The estimate was $46.23 billion, so that's a beat on your top line. Adjusted gross margins, Dan, 72.7%. Let's go through the segments. I look at Q2 data center revenue, $41.1 billion. The estimate was $41.29 billion. Let's get to the gaming revenue as well, $4.3 billion. That beats. The estimate was $3.82 billion on the street. Now let's look for the forecast. What do they see ahead? They see Q3 revenue, $54 billion plus or minus 2%. I don't see a compare there yet, but your initial take, Dan, on these numbers.
Well, if I heard you right, did they miss the data center number?
Let me go back. I did not see, let me get that for you.
I think you said it was 51.1 and the number was like 50.
Data center, $41.1 billion. You're right.
Sorry.
The estimate was $41.29 billion.
So that's an interesting one. That's going to be very interesting to hear what happened because that's been such a buoy for the companies overall.
Let me also get you the compare on the forecast. Q3 revenue, I said 52.9 to 55.1 billion. Consensus was at 53.46 billion. And pulling, Nvidia has not assumed any H20 shipments to China. What do you make of that?
Well, I think that's good. That's upside. I mean, 54, so they came in above that 53 number. So they're not quite at the highest end, but they also came right in the middle, plus minus 2%. And they leave the China opportunity in there. There will be some licenses that could happen in this quarter, and that could provide some upside. But I think they're better off being cautious here. They're able to hit the number, overall beat the number without China in play. That leaves a little bit for the investor's imagination, Josh, that, hey, if China comes back into play, and by the way, this is like a situation that can change on the daily right now. If China comes back into play, there's upside in this next quarter.
I think that we do see, Dan, immediately some pressure on the stock. Now, this is the initial reaction, down about 3%. I think you'd have to chalk it up, at least initially here, to that Q2 data center sales miss.
Yeah, that's the one that stood out to me. My hair stood up on the back of my neck. And,
what do you think we're talking about there in terms of possible explanations for that?
Well, it could be a lot of things. The expectations are very high. Overall, the speed and the ramp of Blackwell, it could be just about shipments. I mean, you're so close on that number. You know, when things ship, when things book, when things hit the numbers.
Does it make you? Does it cause you any concern about just the general AI trend in spend?
They missed by like 100 million on a $41 billion number. I think overall, everything's still very, very much intact. We saw that over the last several months. We listened to the hyperscalers. We've listened to the OEMs that have reported during this period of time. That Nvidia number's been very strong. But I do think, you know, and what our 2029 numbers suggest is, you know, the CAGR in this business is going to fall into the 20s. Dan Hawley said something about law of large numbers. Mm-hmm. I mean, we are hitting a point now where, what do we expect? I mean, at some point, the growth is going to come into that 20-something percent, 2021 by the end of this decade. But they're growing really, really well. The demand is there. The hyperscalers are backing it up with continued CapEx spend. I think it's meaningful, and clearly the street agrees with me, that they weren't able to blow it out after so many quarters of seemingly always hitting that data center number. But you're talking 120 million on a $41 billion number.
Yeah, we should mention the capital return news as well. They do approve additional $60 billion to share buyback. You are seeing some kind of ripple effects here. AMD, they're a bit lower. TSMC comes under some pressure. You think about the great AI trade and trend, though, Dan. I wonder if some investors thought, given what we heard from big tech and how during that earnings season, whether it was Microsoft or Meta or Amazon, Alphabet, they are clearly going to spend building out that AI infrastructure. And the assumption was it was all just going to be gravy for Nvidia.
Well, I think everybody did come into the number with really hot expectations. If you kind of look down the list so far, right? Margins were a little lower than...
Q2 gross margins, 72.7. The street was at 72.1.
Right, but there was a little lower than its peak, was what I was getting at. And I think people had seen those 74%-ish margins and wanted to see, are they climbing back? So they did better, but they haven't returned all the way to those margins yet. There might be a little pressure on that. I think they probably won't get much credit, Josh, for anything outside of data center. I think data center is the focus. Yep. And so that was the number that was missed. But I still said most was going to ride on the guide. And the guide is good, but I think people wanted it to be top of the
I
top
just
of the
wonder if
range.
people see this print and this headline, Dan, and it renews some worries about some type of broader AI slowdown, which has been, of course, a huge reason we've seen the broader market rally the way it has.
Well, I followed the cloud trend a little bit, and you followed this over the years. Amazon, right? Their numbers started to pull back to 15% growth, but they were growing tens of billions of dollars on an annual basis for AWS. That was an example. I think we're seeing some of that here. Is it was growing so fast, it is growing so fast, but at some point that number has to turn into consumption. And I think you and I have actually had this conversation on the show. You saw that MIT study come out, 95% of AI projects aren't delivering fast ROI.
Yep. Got a lot of headlines.
I think while people want that to be a bubble, what I do think is we are overestimating the human's ability to ingest this stuff. Okay, so the technology is going up very quickly. The infrastructure spend is massive. You see these numbers, they're massive numbers. Having said that, the ability for enterprises, for instance, or sovereign clouds to be stood up and be put to use, that takes a lot of time. And we as a society, we as people, have a natural resistance to change that's this frenetic. We do not do that well. So we're not seeing this stuff hit the enterprise. We've heard this kind of software as a service narrative is going to die or is dying. And I've been one of the purveyors that AI is eating software. But this doesn't happen overnight. For Nvidia, this growth almost felt like it happened overnight. At some point, we do need to digest all this, and we do need to start to see more companies, that broadening out of AI being utilized, start to come to fruition.
Yep. All right. Stock down about 2.5% right now. Clearly, that data center, and I think that forecast clearly in focus.
So Dan, you've called Jensen Huang the godfather of AI. You say he delivered once again. But we were just hearing from John Vin about that data center miss being disappointing. We've seen signs of slowing margins. You remain bullish, but are we flirting with bubble territory here, at the very least, seeing some more risks and cracks below the surface?
Yeah, I don't see any cracks. I mean, I think to some extent, when you factor the China numbers in, it's actually even more bullish than expectations. And I think when you look, if you start to go through everything and you're clearly going to nitpick, and was data center, obviously a little slightly disappointing. Yeah, but the reality is you're looking at probably the street underestimating growth by 25, 30%. That's why I think this is going to 5 trillion by early 26.
Can you factor the China numbers in though, Dan, considering all the unknowns that are out there? We just don't know if we're going to get that approval.
Yeah, the problem is that, look, if you're, and there's going to be skepticism on U.S. China, but the reality is that the biggest poker chip at the table is Nvidia. I believe they're going to sell into China. That's what ultimately could be 50 billion, 50% type growth. And again, there's one chip in the world fueling the AI revolution, and that's led by the godfather of AI, Jensen Nvidia. And I think that's how this is all going to play out. There would clearly be ups and downs, but I think when you read through it, that this is I believe just the start of a transformation that's happening in tech.
So then what keeps this rally sustainable and chugging along here? Is it still that data center build out, or do we need to see new AI use cases emerge in order to justify these valuations and for Nvidia to keep performing and outperforming like investors expect?
Look, I think it's about spreading, right? I mean, today it's only big tech, but now sovereigns are going to play. Think about Middle East. Think about everyone. So as this all starts to play out, you're now going to start to see globally Nvidia fueling it. We're talking about trillions of growth, and that's why I think when you look at AI, in my opinion, this tech bull market has 2 to 3 years at least ahead of itself, because we're just starting to play out. We continue to believe it's only 10 p.m., was 9 p.m. a year ago, but it's only 10 p.m. in the AI party. That goes to 4 a.m.
4 a.m. to the party. Now, we were just talking about China. Jensen Huang really stressed the importance of that market in his conversation with Yahoo Finance. And he also pointed to the Trump administration and how grateful he's been for their support. Take a listen to what he told us.
President Trump really understands and really wants, and it's his policy, to have America win the AI race. And that's really foundational. Recognizing that that's important for national security, it's important for our economic security, it's important for American leadership around the world. And he understands that the American tech stack should be the world standard, just as the American dollar is the world standard that economies are built on. I've always enjoyed the conversation with the administration. They're very constructive. They're trying to help. They have a great sense of urgency, which I love.
So Dan, your reaction to Jensen's comments, do you see this as diplomatic posturing in any way to the administration, or is this a signal that policy really is central to NVIDIA's future?
Don't let the black leather jacket fool you. That's 10% politician in Jensen, 90% CEO. Look, right now, I mean, he knows he has the golden touch. And he continues to have that front row seat and really be a strategic advisor for Trump. But the reality is that if Nvidia can't sell into China, guess who gets strengthened? Huawei. So when you talk about the U.S.-China arms race, Nvidia plays a huge role, and that's why I think eventually, I mean, the coast will be clear, the green light's there, it's a pay-for-play model. China will be open.
And how much of NVIDIA's success and really the AI trade broadly tied to what we see in Washington? This feels like a story beyond just NVIDIA, especially as a lot of those big tech CEOs have been cozying up to the president and the administration.
It's new rules of the game, right? And I think, from Cook to Jensen to everyone else, I think everyone's understanding how to play it. And, when you think about everything that's happened in the Beltway, it is going to play an important role. Because right now, it's this arms race playing out between U.S. and China, tariffs clearly play in, and you guys see how the restrictions ultimately play out. But the reality is, for the first time in 30 years, U.S. is ahead of China when it comes to tech because of the AI revolution. And because there's only one chip fueling the AI revolution, it's godfather of AI, Jensen, Nvidia.
Mm-hmm. Now, speaking of big tech navigating Washington, navigating policy, Apple has been at the center of that conversation. We have the upcoming iPhone event. They just announced that date early September. Do you see that event as a catalyst for the stock, especially considering Apple shares have underperformed?
Look, it's a catalyst. I believe it's going to be a big upgrade cycle, and we've talked about it. But the reality is, Apple, they're playing baseball without a shortstop and a catcher. They're missing AI. And there's only one way they're going to do it. It's not from innovation within Cupertino. They're going to have to do an acquisition, whether it's Perplexity as well as doubling down the Gemini partnership. I think that combined with iPhone 17 are the keys to what I view as, a stock going much higher, but they cannot miss this AI boat.
But Apple hasn't really been the buyer of assets, right? So I guess what do you think it would take, or what company would it take for them to really change that mindset?
We think it's Perplexity. I mean, it's clear as day that innovation's not going to be coming out of Apple when it comes to AI. And that's why I think they're going to have to do an acquisition. I think the writing's on the wall, and this is the time.
And another debate that was popping up a lot online, it was even a top Google trend, is Nvidia versus Microsoft. Obviously, two very different businesses here, but if you could only pick one that you would want to have in your portfolio over the next 12 months, which company do you think is best positioned?
That's like picking which of your kids you love.
I know,
the
it's
best.
hard.
I mean, come on. But look, I think those two, they'll both, I think they're both going to be in the $5 trillion market cap club. And I think when you think about who's fueling it, it's Nvidia and Microsoft. And those continue to be our two top picks along with Palantir.
Mm-hmm. And it's because of AI. They're just utilizing those AI use cases the best out of the rest of the Mag 7.
They're playing a different game. They're like Scotty Scheffler playing golf.
All right. You heard it here. Scotty Scheffler playing golf. Dan Ives, thank you. Appreciate your insights as always. Does NVIDIA truly need China in order to sustain this growth story?
I think China is an important part of every major tech company's future, right? They account for roughly 20 to 30% of end consumption more broadly. And within tech, they are always on the leading edge in terms of adoption of the latest technologies that we've seen with their EV cars, as we've seen with AI. So they are an important piece of the pot. I think NVIDIA can sustain outsized growth without China. But certainly, China is going to be a very key driver of generative AI growth going forward.
And to that point, John, Nvidia's guidance was solid even without China, but the company did say that its forecast would have been $2 to $5 billion higher if those sales were included. So as an analyst, how do you model that kind of uncertainty? Because China, it's still unresolved. That 15% revenue share agreement in Washington has not yet been codified. So where are you looking at?
Yeah, I think their guidance, which excludes China, is probably the most prudent path forward. I think even if they were to include China, I think in the back of investors' minds, I think everyone would also want to understand what the China contribution is, right? Like the challenge with China is if it's, we're going to allow shipments back, but is the administration going to flip-flop back and forth as they've done in the past, right? So I think the best path forward, as we've seen, and the most prudent approach is for NVIDIA to guide without China. We know obviously it's a source of upside, given that they've announced that some of those licenses have been approved. But I think going forward, I think we've excluded China from our numbers.
And you did raise your price target to $230 a share. That's up from the prior $215. Part of that reason is a $60 billion buyback authorization. What other catalysts are you seeing here when you look at the upside ahead?
Yeah, we're looking at a couple things right here. One is the ramp of their next generation Blackwell Ultra. It's going to carry higher ASPs into the back half of the year. They've already talked about shipping tens of billions of dollars in the second quarter. That's only going to be a bigger driver in the second half. The second thing is the improving rack shipments of their GB racks, right? This has been an area where they've been supply constrained, heavily supply constrained in the first half. We believe that they've been making significant improvements in terms of manufacturing yields. They talked about being able to ship about 1,000 racks per week right now. And as that flywheel starts to improve here in the second half, that also is going to be a significant upside driver. Those racks sell for anywhere from $3.5 to $4 million per rack. So you're going to see a nice ASP uplift from that going forward.
And we are seeing shares down about 2% this morning. That data center miss is still the core of NVIDIA's story, and that seems to be what investors are focused on right now. How did you interpret that number, and what does that signal about the sustainability of demand, especially as Blackwell continues to ramp up?
That number was certainly disappointing, no question about it, right? There was also $650 million of sales of H20 China GPUs to a non-China customer. They said it was a one-time deal, but if you excluded that sale, numbers would have probably been in line or potentially a slight miss. But I think going forward, I think the most important thing that most investors looked is the guide. In terms of the near term, I don't think that this represents a deceleration in demand. I think this is more of a supply issue, as we talked about with the GB racks.
All right, John, thank you so much. Appreciate your time.
Great, thank you.
Boston Wires, let's get you those results. Q2 EPS 231 versus an estimate of 218. It looks like revenue 96.43 billion versus an estimate of 93.97 billion. I'm just looking at Google ad revenue, 71.34 billion. The estimate was 69.71 billion. Turning to different segments, Google Cloud revenue, 13.62 billion. Estimate was 13.14 billion. YouTube ads revenue clocks in at 9.8 billion. Street was closer to 9.56 billion. Also looking ahead, they are seeing full year CapEx. They're now looking for about 85 billion. They had seen about 75 billion, and the street consensus was more like 73 billion. Just looking at how we're getting an instant reaction here in the after hours. Remember, this stock was basically flat year to date heading into this print. Right now, down about 0.5%. Dave, you're looking over these headlines like I am. Your immediate response, Dave.
Yeah, no, so I was looking at their actual reaction to the stock, and at first it looked to be positive. To your point, as you're going through the headlines, sort of the top line numbers look pretty strong. But then when you kind of begin to peel back the onion, and we'll need to see more to come on the call, that CapEx spend number coming in well above street expectations and what was previously guidance, is definitely a bit concerning, especially when we're seeing nice growth from important segments of the company. but not necessarily gangbusters.
It's interesting because heading into this print, like I said, you were basically flat year to date. Couple different issues. One was AI search, right, and where they are in this AI market. The others was this monopoly lawsuit. It does seem like we'll have some immediate questions, though, about this CapEx number, Dave. Again, it looks like we're looking for full year CapEx. Now they're calling for about $85 billion. They had seen 75. The estimate was 73.
Yeah, no, exactly right. I think in general, the question that we've had heading into this earnings season, and I think it's we're not alone here, is just how much CapEx is going to continue to come, right? So this is an arms race, right? We're still in the very early days of building out data centers, building large language models. At some point, though, there's going to be a preference that either corporations have or consumers have on sort of what AI models they want to use and how does that sort of all play out. But for the time being, every company needs to continue to plow ahead here. But seeing sort of, I'm going to be very curious to see, well, what exactly are they planning to spend this on? Is there something new? Because again, we still don't really know exactly what's going to happen with that monopoly lawsuit and the impact that could have, to Chrome.
Some more headlines coming out, Dave. They talk about how cloud annual revenue run rate over $50 billion. Of course, in that space, they're competing with the heavyweights like Amazon, like Microsoft. They talk about how they continue to see strong performance in YouTube. They talk about how AI is positively impacting every part of the business. I mean, the worry there, Dave, one concern has been about how AI will impact search, will impact Google's bread and butter. How do you think about that dynamic?
Well, I think that, again, they're a company that sort of has the ability to sort of integrate AI into a lot of different operations, right? So they are not, Alphabet's not a pure play company, right? So obviously we know that it's dominated by search and sort of the ad revenue there, but YouTube has been a really bright star for it for some time now, and the ad revenue that can come from there. And if you can begin to integrate AI into sort of those products and systems, it's going to make their business benefit pretty markedly. But at the same time, they face this existential threat of, is there going to be something new, the new when it comes to search, right? I know, like a lot of folks, I'm using ChatGPT and other tools above a browser more and more. And at some point, that's going to have to kind of come to bite them. But that's why they're kind of really so focused on sort of integrating Gemini into all of their different products and offerings.
Just your immediate thoughts and reaction to the results, Dan, with the stock under some pressure here, at least initially.
Yeah, it looks like it's that CapEx spending, that extra $10 billion that we're seeing from the company. There's also, they saw the growth on both the cloud side as well as on the advertising side. I think the positive AI commentary is important given that they're expanding that CapEx. But, as you guys are talking about, there's no real understanding as to where that extra spending is coming from. Is it because of tariffs? Is it because of something else along those lines? Are they investing more into other companies? Obviously they had purchased Windsurf, got in on that. So is it more along those lines? Is it the hiring? Where is this spending going? I think that's where people really want to know what's going on.
Rohit Kulkarni is here with us to talk more about that. Rohit, the at least the initial reaction here after hours, stock's at about 2%. As Dan was just mentioning there, Alphabet sees CapEx, full year CapEx about $85 billion, Rohit. They had seen about $75 billion. The street, I don't know where you were, Rohit, was more like $73 billion. What do you make of the results? What do you make of the reaction so far in the after hours?
I think fundamentally, I think we are seeing acceleration in revenues in a very large company. Google search is accelerating. YouTube growth has accelerated. Google Cloud has accelerated, and even subscriptions have accelerated. We agree that last Q2 there was slowdown, but they are compensating for acceleration, and we are not seeing any sign of existential issues that investors have been focused on as far as AI search is concerned, or what ChatGPT attention is taking away from Google. Having said that, I think the stock reaction here is a knee-jerk reaction about where are you going to spend those extra $10 billion, and what is the ROI that you're seeing from the existing spend. That's a sentiment that probably drives a lot of other mega caps, in my opinion, Josh, where Google is probably generating the most amount of cash and they have the cushion to spend that cash. But we would love to know, is this an indication of supply chain constraints are easing up? that more chips, more power, more data center room is available, so they're able to spend more this year? Or is there something new or fresh from an investing standpoint that they have found?
So Rohit, when that question is asked on the conference call about this CapEx, about 85 billion, they had seen about 75 billion. What do you think they're going to say to that, Rohit? How will they explain it, do you think?
In my opinion, what they will cite as a kind of proof point number one is look at our results. Our results show acceleration in advertising revenues, in cloud revenues, and if we are seeing acceleration, it's because of some of the investments that we did over the last 12 to 18 months, and the investments that we are planning to do more of. Those same investments give us more confidence of a bigger return over the next 12 to 18 months. I feel that this is a show me quarter that everyone was piling on Google about fundamentals showing any signs of cracking from a revenue standpoint, and we haven't seen that at all. I think from a revenue upside, this was as comprehensive of a revenue beat as we have seen from Google in the recent past.
You know, other big tech names, Rohit, I'm thinking about Meta. Now, they'll spend, but some of your colleagues on the street, Rohit, they'll say, well, we like that spending because we can see where it's positively impacting results. Talk about users and advertisers. Yep. Would you say the same about Alphabet?
It is, although we don't have a full disclosure in terms of what it is actually helping from a usage.
Q3 EPS looks like 157 versus estimates of 143. I see revenue 94.04 billion versus an estimate of 89.3 billion. It looks like iPhone revenue 44.58 billion. That is also a beat. The street was at 40.06 billion. Josh Schaefer, looking at you, what do you see in these results as well?
Yeah, Josh, I mean that iPhone beat really popping off the screen to me, right? To see iPhone revenue coming in at almost 44.6 billion, and that was above the street estimate of 40.06 billion. Also some other beats across the revenue spectrum here. I'm looking at Greater China revenue coming in at 15.4 billion. That's above a 15.2 billion estimate. Then you go down to products revenue overall, that coming in at 66.6 billion, above a street estimate of 62 billion. Again, that smaller Mac revenue segment coming in at 8 billion, above an estimate of 7.3 billion. So it seems like some of the key products for Apple here driving better revenue than the street had expected. Stock was initially up 3%, Josh, right as this release crossed, coming down a little bit now, up about 1%. But that seemed to be the instant read through. Of course, we don't have guidance from Apple in this release. That's kind of one of the key questions that I know I was seeing from analysts moving forward is they're going to want client inbound about where margins are going to be in the coming quarters and sort of the tariff story that relates to those margins, right? What happens to margins in the out quarters is a key question that there's no real insight to, at least in the release.
Yeah, on the call for sure. I think you're nailing it. And that'll be a big, how do they address the guidance, how they talk about the forecast? That'll be a big focus. Tariff impact as well, Josh, is going to be in focus because you're looking for more clarity there. They did say last quarter, remember, to expect a 900.
Hey, Josh, yeah, Amazon stock been trading on both sides of the flat line after this report came out. So I'm going to give you the high-level numbers here. Amazon reporting revenue of $167.7 billion. That was against a street estimate of $162.1 billion. So a beat on revenue there, also a beat on earnings per share. Amazon posting adjusted earnings per share of $1.68 against a street estimate of $1.32. I do want to read some other key metrics for you here, Josh. So the second quarter operating income, that came in better than expected. Amazon posting second quarter operating income of $19.17 billion, above an estimate of $17 billion. But key metric here that I think has maybe perhaps held the stock back, reading through the report, I would have thought maybe up. You take a look at the third quarter operating income guidance, pretty wide range from Amazon here. Amazon with a range of $15.5 billion to $20.5 billion for operating income. Of course, that's perhaps where maybe tariffs could come into play, right? The street was looking for an operating income in the third quarter of 19.42. So Amazon with a wide range. The low end range of that third quarter operating income is lower than what Wall Street had hoped for.
And Jeff, I want to bring you here as well because I think you hold this one. Another metric is AWS sales, of course. That's what folks are going to make a beeline for. It looks like AWS net sales ex-FX plus 17%. That is smack in line with estimates.
Wow. Okay. No, yeah, AWS is where my attention goes to all this. That's the growth engine. for where Amazon's going to go. They obviously, I'm assuming we'll find out in the actual text, but with that wide range, I'm assuming they're building in some tariff concerns, especially around there on the low end.
They have also, I remember, Jeff, too, and it'll be interesting how they comment. I remember they've also talked about in the past being, on AWS specifically, being capacity constrained, and I wonder if that's another issue that'll be brought up.
Well, that's an issue with all AI, right, of capacity from a power perspective, and just getting the products here to continue to build and grow it. I expect AWS to continue to be the growth engine. They have some headwinds there, obviously, like we've touched on a little bit, but that's a great number for me. And I definitely want to dig into that forward-looking guidance of what they're worried about.
I also wonder, to the extent that, obviously, now this is the last of the cloud giants to report. We had Google, we had Microsoft, and then Azure print, which really impressed people. I think it was 39% maybe. And I wonder, I wonder if that was set some type of bar for them as well, AWS.
Yeah, it's tough if you're not the best looking girl at the dance. And that's where kind of Amazon might be coming in here, right? Next to Microsoft, it looks bad. In a vacuum of totality with Amazon, though, it's a good number, but compared to Microsoft, I can see why the street might react negatively.
What do you think, Josh?
Yeah, well, I think when you think about that Microsoft Azure number, I mean, we were talking about this on the morning show this morning, to surprise Wall Street by over 4%, like Microsoft did yesterday, they hadn't done that in over 2 years, right, for that Azure growth. So to see acceleration in that part of the business is a huge story for Microsoft, and it just sets perhaps a high bar for Amazon. And you also brought this up earlier, Jeff. I mean, the stock was already up 2% today, too, right? So we're looking at a stock that's essentially trading almost flat over the last 24. Like, it hasn't moved a lot, and it's certainly not selling off. I think this is a company where you definitely want to hear more on the call, especially when it relates to AI and what is AI doing for AWS, right? That was a story Microsoft told very well last night on the call.
To be careful, because every iPhone device or Apple device in my is going to go off. But if you think about Siri as an example, so we now have more information on the timing for using artificial intelligence to upgrade Siri. It's expected calendar next year, so it's at least 12 to 18 months late. And then this holds true for Alexa for Amazon, meaning that in the future, if consumers are looking for a digital assistant, will it be Amazon's, will it be Apple's, or will it be OpenAI's? So how functional or how important is your smartphone in the future if the main primary features or the things you value most are not necessarily coming from Apple? I think that's a challenge.
Well, but how would you access those things, I guess, is the question. Like, yes, your Alexa, you got your, whatever your device is at home, but you don't carry something with you typically that has Alexa unless you access it through your phone. OpenAI right now, you get to it through your phone or your device, right? So in other words, are you seeing a near future where these other companies will also have other ways for us to access it?
Yeah, so the concern is, from a dislocation standpoint, when does the smartphone become less instrumental to a consumer's experience with the internet or with technology? And I would say that so far, the shelf life or the product life for smartphones has been incredibly robust and incredibly long-term. But I guess the question is, we talk about the Internet of Things or things of that nature, but what happens when you interact with the internet in your car, or you interact with the internet on perhaps a smart TV, devices that aren't your smartphone? How significant will Apple be in the future? And really what's driven the stock for the last 12 to 18 months, perhaps 2 years, is the services revenue growth. Well, what happens to the services revenue growth for Apple if hardware sales not only stagnate, but decline? And I think that's a big long-term concern that investors have for Apple.
Now, Tim Cook did say on the call that they're sort of cognizant of a post-smartphone world, right? Like maybe it's glasses, maybe it's something you wear around your neck, maybe it's a chip in your brain, I don't know. I mean, did you find that reassuring at all?
I found it reassuring because he said it in a manner to suggest, Julie, that they're working on things that he didn't want to highlight. Meaning that, so Apple could have a smart ring, or Apple could have maybe not the Neuralink brain chip, But Apple could have all those products consumers may use in the future to interact with technology and to access the internet, things of that nature. So the manner of the way he said it suggested to me that Apple's working on things, and I think that's good when the day comes and the smartphone's less, significant.
We will look ahead to that day. I don't know about look forward happily, but we'll anticipate that day.
Look at that move in the price.
Yeah, Josh, you're seeing a big move in Meta there. Shares up almost 9%. So I want to just hit the high-level numbers here for you first. So in that second quarter, Meta reporting adjusted earnings per share of $7.14. That was against a street estimate of $5.89. So a pretty significant beat there. Meta also reporting revenue of $47.62 billion. That was above a street estimate of $44.83 billion. Then you move over to Meta's Q3 guidance. That also coming in better than expected, at least up from a sales perspective. Meta guiding for a range of $47.5 billion to $50.5 billion. Street estimate was looking for 46.2. Of course, Josh, when we talk about a company like Meta and how much they've been spending, CapEx is a key part of this conversation, right? So Meta moving up their CapEx range for the full year to $66 billion to $72 billion. The bottom part of the range had been 64. So yes, boosting that range a little bit, but remember, they had actually boosted their full year CapEx guidance, the entire range, going back to last quarter. So I know some analysts on the street were perhaps worried to the extent that Meta had been spending, and perhaps too big of a move in CapEx would have been downside for this stock. But right now, most of those numbers I read, Josh, significantly better than what the street expected, and you're seeing the stock act like it.
Huge move. We're up more than 9% now in the after hours. I mean, to your point, Josh, we know this company's all in on AI. They have been spending, they've been hiring. You just heard Zuckerberg talking recently. The company's going to spend hundreds of billions of dollars to build data centers around the country. Bulls, of course, to your point, though, they look at all this spend and they believe, and investors seem very optimistic, that there's going to be some long-term meaty ROI on all that spend. It's not just the spending, it's the hiring. We were talking to Dan Howley earlier, how Zuckerberg continues to poach just top AI talent from his rivals, which is, I mean, listen, reportedly the pay packages are incredible, but you also do kind of wonder, is it just the pay, or do a lot of folks, are they excited to also just work with Zuck on his AI projects and his AI strategy?
I would think that's going to be a big discussion on the call, right? Is sort of what is exactly going on with a lot of this investment. And Meta did call this out in their release too, Josh. So Meta said they are expecting upward pressure on 2026 total expense growth rate. We expect the second largest driver of that growth to be employee compensation as we add technical talent into priority areas. So they're already getting out in front of it and they're talking about it. They know that this is a big topic of discussion. It feels like over the last month and a half or so, most of the headlines surrounding Meta has been how much they're paying employees to get talent over there and continue building AI. Finally, just to give a quote from CEO Mark Zuckerberg, he's talking about superintelligence, of course, Josh, which I still don't quite understand necessarily at this point.
Just ask Howley.
He's excited to build personal superintelligence for everyone in the world. So we're going to know more about it at some point.
I did see even some well-known bulls heading into this print. Bulls saying they thought that, hey, the valuation is kind of screening expensive here, but look at this one. We're up 9% over here in the after hours. Thank you, Josh. Well, Meta and Microsoft surging after reporting their latest quarterly results. And join us now to take a closer look at the Mag 7 names. Let's get to D.A. Davidson Managing Director Gil Luria. Gil, it is great to see you. So big tech reports and making big moves here in the after hours. Gil, I know you cover both these names. I know, Gil, you like both these names. Let's start with Meta. This stock is up now 10% in the after hours. What do you make of the results, Gil? Is that move justified in your opinion?
Yes. Yeah, the results, the stock moves make sense. The results are that good, both for Meta, and we'll talk about it in a second, for Microsoft. From Meta, they were able to grow revenue 22%. That's a significant acceleration from last quarter. And the context is Google grew its ad business closer to 12%. So Meta is gaining significant share in the digital advertising market. They're doing it with while keeping, at least to date, expenses under control, and therefore investors have patience for the CapEx guidance that they're providing. For this year, it's only a slight increase, but there was a comment in there about a significant increase in CapEx again into 2026. Investors will have patience for that, As long as revenue is growing this fast, they're selling a lot more ads and they're selling them for a lot more.
So they're spending, Gil, but is your point, listen, we're seeing the ROI on that spend?
To some extent, it's more that investors with Meta have always had patience for the longer term investments when the current business is doing well. When the digital advertising business that is the lifeblood of Meta is doing well, investors have patience for Reality Labs, for Metasphere, and now for these longer term super intelligence investments. That's what's happening, which is to say, the AI investments do pay off in the core business. This is how we sell more ads, and we sell them for more, is by being very good at AI, by being very good at developing the right feed and serving the right ads, and then being able to monetize that, which Meta is getting increasingly good at. But the investment is well beyond that. The investment, as you talked about earlier in the hour, is about Mr. Zuckerberg's pursuit of super intelligence, whatever that may end up being.
Let me ask you, Gil, taking a step back, when you think about Meta's role, strategy, competitive advantages in that broader AI market, how would you define those advantages?
Well, so one is they're working towards another platform, the next platform, hence the Meta Ray-Ban glasses and Oakley glasses. They want to have the next platform because they don't like that fee that they have to pay Apple and Android for having their applications on their devices. They want their own device, and AI is a big contributor to that. And then they're also working towards having the dominant AI model. Let's not forget, a year ago, Llama 3 was cutting edge, was state of the art. Llama 4 failed, which is why they have now gone and aggressively invested in talent. So the next iteration of Llama can again be state of the art. So they can again be front of the pack in this pursuit of an omnipotent AI model.
To your point, I mean, Zuckerberg is aggressively poaching successfully top AI talent from rivals. When you think about the risks to this one, Gil, I know you have a buy on this one, but when clients ask you, what are the risks I do need to think about? What do you tell them?
That founder mode is great when things are going well. It's been more challenging owning Meta and before that Facebook when things don't go as well. If the advertising market rolls over because of a weaker consumer, investors may lose patience for Mr. Zuckerberg's aggressive investment. So that's the two sides of the coin are when things are great, you want to have founder mode. When the core business doesn't do as well, you have a little bit less impact as a shareholder.
Let's switch gears here, Gil. Microsoft, another name you cover, another name you like. Also, Gil, we are surging higher here in the after hours. We're up more than 7%. What do you make of those results?
They're even better than it seems. This is a company, one of the largest companies in the world that just grew revenue 17% year over year. Their Azure business grew 39% in the quarter. That's a business that's going to be more than $100 billion this upcoming fiscal year, growing 39%. And it's not just the cloud hosting business and the GPU access business. Those businesses are growing so fast, but they're also drawing with them the rest of Microsoft business. They're growing their consumer business, their enterprise software business by high teens and into the 20% range. This is remarkable growth at this scale. It far exceeded expectations. And unlike Meta, they are doing this with more responsible spending. They are figuring out a way to invest in CapEx, build this new capacity, but they are also finding ways to offload excess capacity in the short term so the CapEx numbers don't get out of control. That's why they're also going to be adding about $200 billion of market cap tomorrow.
On the call, Gil, the conference call, that's when you traditionally expect CFO Amy Hood to provide guidance. What do you think we're going to hear there in terms of a forecast?
So I would expect her to try to tone down expectations so that we don't all raise our numbers by the extent of the beat today, but continue the optimism and continue to talk about how they're meeting demand. And then a more nuanced conversation of CapEx. That's what a lot of investors are going to be listening for, is how much increase in CapEx is there going to be into fiscal 26 in order to continue to support this growth. She has already said that CapEx will grow, and it will grow at less than it grew in the last fiscal year. She's going to refine that guidance for us, and the point to which they're investing in CapEx will tell us how much more efficient their business has become.
Let's say you had the chance to ask CEO Satya Nadella a question or two on that call. What would be top of mind for you?
Is the growth in AI going to drive GDP growth of 5 to 10% in the future? I think this is where a lot of the conversation is AI growing exponentially, which again is how we explain Mr. Zuckerberg's investment. Is it going to accelerate growth for Microsoft and all of its customers to a large extent, which again would justify some more investment? Or are we still believe that we're in the current patterns of growth that require more caution on the investment? That's really the big question now, because let's not forget, Microsoft is so big that a lot of their growth depends on how much AI accelerates the growth of the overall economy.
Gail, always good to see you, my friend. Appreciate that instant analysis. Thank you.
Thank you.
Microsoft, bottom line, I'm seeing a Q4 EPS print of 365. I don't see a compare yet on that bottom line. The top line, though, I see Q4 revenue, $76.44 billion. That is a beat. The street was looking for $73.89 billion. Another key metric, Q4 Azure and other cloud revenue, XFX, that is growing, that pops 39%. That is also better than consensus. The street was looking for closer to 34%. Azure's surpassing, it looks like, $75 billion in revenue this year, up 34%. And not surprising, Josh, here's another big tech name. They report, and that stock moving 7% in the after hours.
We were just talking about Meta, Josh, and you mentioned some analysts perhaps being worried about valuation, right? Well, look at Microsoft stock since the bottom. The stock's up 40% since April. Like, we are not seeing a 7% move in Microsoft right now on a stock that has not been significantly rallying. It's essentially trading at an all-time high. So it gives you a sense sort of how much investors like this report. I think that Azure beat, as you pointed out, certainly key. And then I think you tie these two prints together, start to form a little bit of a macro narrative from what we're hearing from two big tech giants here. Continued raising of CapEx guidance, right? Or at least reaffirming of CapEx guidance. They're continuing to invest in AI, and also continued earnings beats. When you think about what has been the key driver of big tech over the course of this rally, it has been, yes, the expectations are always high, and they continue to move above that bar, right? And you're seeing that happen once again for what feels like a lot of consecutive quarters in a row now for several of these big tech giants.
To your point, Josh, analysts were quick to emphasize the bar was high here into this print. I mean, the stock had been on a run since that last print. Listen, you're going to more talk about Azure momentum, Copilot adoption. What do the trends look like there? CapEx spending trends. It looks like Q4 CapEx, including leases, $24.2 billion. Street was closer to $23.17 billion. But lots of attention here on AI, on the cloud businesses, and of course, you'll be waiting for the call. That is when you would traditionally hear CFO Amy Hood tell you about the guidance, give color on that forecast.
And then, as Dan Halley has pointed out too, Microsoft has been one of the companies that's early in their release and in the call to really sort of line item where AI is impacting their business. You know, AI is contributing X amount % growth to Azure. AI is contributing X amount % growth to another part of the business. Maybe it's Copilot. And so how they're able to lay out those numbers usually talks well to the street and talks well to investors. So as we think about what's coming in the call and sort of things to watch, I'll be looking at that.
We've been talking about this sort of tipping point that we've been reaching with these companies, and I know you've been talking about it for a while, even though, as you and I have talked about in the past, maybe it's unfolded a little bit more slowly than at first promised, but it feels like we're there. Is that what these results tell us?
I mean, we're at the beginning of the AI adoption cycle, and I think everyone's been questioning these CapEx investments. What we've been saying is they're seeing accelerating revenue, they're seeing accelerating bookings, they're seeing margins that are higher. Amy Hood just gave you margins that are higher in the last 2 years, even in the face of AI. And they've guided to flat margins, which is still pretty incredible given all the investments that are going in. So I'd say that we're not there yet. The enterprise still has not adopted AI, and that wave is yet to come. And so if you think about today across the entire software industry, less than 5% of total revenue is AI. And when that gets to 15, 20, 30% in 2027, 2028, then we'll be there. We're clearly there on the investment thesis, which is you want to be ahead of this AI wave. There is, as I've said, only 5 companies that really monetize AI in a big way inside software, which is the companies that have the data, have the users, and have the capital.
But Dan, you wanted to get in here.
Yeah, look, Brendan made a point. AI is not throughout the enterprise yet. He's right. We talk so much about the cloud. A lot of businesses aren't in the cloud still, right? There's so many businesses out there. The cloud in and of itself still has some runway to go. We were talking about, Microsoft was talking about their on-prem business, which is their on-premises business, where people stand up servers in their own individual office buildings. Maybe they need to have them more secure or whatnot. So that's part of their cloud business as well. The cloud in and of itself still has runway. This is the beginning of AI. We'll obviously see if it continues to build like this. But if it's anything like the cloud, then there's going to be continue to be more and more space for it to build out.
Something else I want to point out that you and I were talking about this morning and that Laura Martin of Needham pointed out is the relative spending of these various companies, right? The CapEx. And I think the point that she's making with respect to Meta in particular, on which she is neutral equivalent rated, is that if you look at something like CapEx to sales, in other words, how much these companies are spending relative to their size, the size of their revenue, Meta is a lot higher than the others in terms of the amount of what it's bringing in that's going out the door for this stuff. And she's really questioning the rationale of Meta on that front. Now, the noise on that has gotten a lot quieter with regard to Meta, right? But, it's interesting that she's still bringing up that point.
Yeah, and look, I was just pulling up Meta's market cap. They're going to continue to spend, as I said, on the data centers as well as the people. They're building out this data center that's like, I don't know, they overlaid it on an outline of Manhattan, and it takes up a huge chunk of the city itself. Not going to obviously land in Manhattan. It's going to be somewhere else in the country, I think Tennessee or around there. But their market cap is 1.96 trillion right now. Microsoft seemed to indicate that they were going to be slowing a bit on their CapEx, whereas Meta is saying, look, we're going all in. We're doing AI for ourselves. We're doing open source. So it seemed to indicate that they're not going to be open sourcing all of their AI models going forward. And then they have obviously the consumer business as far as hardware goes. So they continue to lay these out. But you're right, it does seem a little misbalanced when you look at, okay, Microsoft is powering these data centers, using them for enterprises with thousands of people, and then consumers as well. And then Meta's offering up its services to advertisers, but then regular folks who are on Reels and scrolling through, I don't know, whatever, food or people's vacations or my very basic pictures of beer and food and video games. It does feel strange.
Yeah. Yes. And so, Brent, let's go back to you on this. I think we have you back. Maybe, hopefully.
Hi.
There he is. There he is. So we were just talking about a point that one of your peers on the street brought up, which is sort of Meta's CapEx relative to its revenue, and that it's higher than pretty much all of these other companies. Does that concern you at all?
No, because they're in the consumer world and they're monetizing this. If you think about what happened, Meta's headcount is actually down from the peak. And so they're generating accelerating revenue and profits despite all these investments with fewer people. So what does that tell you about AI? It's working. They drove in the quarter 9% price increase in advertising, and it's because of AI. So the CapEx number, I think, is just getting completely overblown, which is like, if you're spending the money, you're getting the return. Who cares what they spend? And last night we raised our CapEx number for the industry. And just in the last week, we've raised Google, Meta, and Microsoft by $50+ billion. And what I'd say is you're seeing this in the numbers. Microsoft accelerating Azure. improving operating margin. Amy Hood, the CFO of Microsoft, gave you operating margin improvement for the last 2 years in the face of AI. Meta just gave you accelerating revenue growth and improving margin with fewer headcounts, and it's because of AI. So the point is, like, who cares what you're spending as long as your bookings and the revenue growth and the margins are going higher, and that's what's happening. So I think there's just, again, I understand that the number one question I get from our investors, which are institutional investors, feels like the railroad companies. Like, we're putting these railroad tracks in, we don't know when the ROI is coming. That's not true. You see the ROI today. The numbers are very clear. And if people listen, you're hearing it. Amy Hood has said this. AI margins are higher than cloud. What does that tell you? So I don't know. I don't know how to be, more crystal clear. Revenue, margins, building, accelerating in the face of all these investments. And by the way, we're literally at the beginning of this wave. We're not at the end of it. And so, again, I think in many of the past cycles we've been in, it takes longer for this to happen. Cloud took a long time. Internet took time. We've lived through these cycles. This cycle's happening faster. And oh, by the way, every CEO from JP Morgan to the CEO of Medtronic to the CEO of United Airlines you go through it. Every CEO, including our own CEO, we're all being asked at Jefferies to embrace AI. And if we don't, there's big consequences. So I don't think this is a question of, is this paying off or not? I think it's pretty clear it's paying off, and you're seeing it already in the numbers.
Yeah, and when I was talking about the tipping point earlier, that's kind of what this quarter feels like in particular, that the proof is really showing up for these companies. All right, going to leave it there. Dan,
it's super early. I mean,
yes, it is definitely super early. But we'll see how it goes. Brent, Dan, got to leave it there. Thank you so much. Appreciate it.
Checking in now on Apple's third quarter results. They are just crossing the wires, and let me get those to you. So Q3 EPS 140 versus the 135 that was expected. Revenue up 5% to 85.8 billion. The street was closer to 84.46 billion. So beats there on the top and the bottom. Gross margin hangs in there, 46.3%. That was better than expected. Turning to the segments, iPhone 39.3 billion. The street was closer to 38.95 billion. Services 24.2. Estimates were close to 23.95. Mac up 2% to 7.01 billion. iPad up 24% to 7.16 billion. Wearables, home and accessories 8.1 billion in the quarter. Finally, Greater China 14.73 billion. Estimates had called for something close to 15.26 billion. I did have the chance, Julie, to speak here with CFO Luca Maestri. Let me bring you Maestri's comments. Overall, he would characterize this as a very good quarter. It was a June quarter record, he said, on the top and bottom lines. By segment, he said iPhone revenue did actually grow when measured in constant currency. He also called out the installed base of iPhones, set a new all-time record, so that's important. He's referring there just to the number of active iPhones in people's hands all around the world. Of course, let's also talk about China, which missed expectations. Luca Maestri telling us, listen, we're seeing positive. One, he said business is improving as we kind of move through this cycle. In constant currency, he said the decline was actually less than 3%. So he's saying currency playing a factor there. All-time iPhone install base record there, he told me. Top 3 models in urban China were iPhones. They feel good about the business. Guidance, we know, will come on the call. Luca Maestri will give a forecast, at least color and commentary at that point.
It was very interesting to watch the stock reaction as you were speaking, because it was kind of bouncing around between positive and negative. Now it's a little bit more solidly positive here. Something to point out, just context-wise, when we look at the big picture for Apple, this is a rebound in sales growth, right? Because the company's sales had fallen for 5 of the past 6 quarters. So that 5% gain in sales, better than the 3% that was estimated, that's got to be a relief for the Apple bulls out there. So that's something to point to. Of course, as you say, the forecast is going to be really important. And of course, to beat the drum, anything they say about AI AI and how AI is going to inform their next iOS, how it's going to inform demand for their devices going forward. It feels like that's really the other item that the street wants to get more
You can bet on
clarity
that
around.
call. Analysts are going to be all over that, trying any which way to get some commentary there.
Will they get any? We'll see.
We'll see. One more issue here, capital expenditures, Julie. Just want to touch on that because there's a lot made. Apple's big tech rivals are obviously spending a lot on CapEx, building out these data centers to host AI services. So I asked Luca Maestri, just how are you thinking there in Cupertino about CapEx plans, especially to capitalize on the AI opportunity? Luca Maestri telling us, listen, we've announced Apple Intelligence. We've made all the investments we need to. We're going to continue making investments. He also reminded us that people compare us to these other big tech companies, but he pointed out, listen, we have a different business model and operating model. It is a hybrid, he reminds us. We do a lot of work in our data centers and partner, though, with others and use on their data centers. So he's just knowing the differences here between himself and others. People excited about Apple Intelligence. It is another reason to upgrade the iPhone, he said. For more on Apple earnings, we have Angelo Zeno, CFRA Research Senior Equity Analyst. Angelo, it is great to see you as always. Those Apple's results just crossed. Your reaction to the report, Angelo?
Yeah, Josh, thanks for having me. I'd say overall the numbers were pretty good, right? But the question isn't necessarily about the quarter. It's kind of about the guidance here for the September quarter, and maybe to the point that you guys had just talked about. What is the outlook thereafter? And what I would say is, there was likely some sort of pull-in effect here that went on in the June quarter, given that we saw such strength almost across the board as far as the product revenue was concerned, and likely that had some impact due to the uncertain tariff landscape at this point in time. So again, it really is going to be dictated on what happens, what Tim Cook has to say on this call as far as what that forward guidance is going to look like.
Angelo, you mentioned tariffs. That is a key question here. I mean, as you try to model this and forecast, what do you think that financial impact could look like for Apple in the quarters ahead?
So here's the issue. Nobody really knows, and I don't think Apple knows themselves. And the problem right now is, and a big reason why they're probably going to provide limited guidance here for the September quarter. I wouldn't even be surprised if they avoided, guidance on potentially the revenue or the gross margin side of things. Listen, there's a lot going on here over the next 5 to 6 weeks for Apple, right? I mean, you kind of look into just the month of August alone, you've got likely some sort of clarity from the 232 pending semiconductor investigation, where that's really where the tariff situation hinges for Apple. And whatever number comes out of there, is it 25%, is it 50%, what have you, is going to partly dictate what Apple is going to be penalized here, at least on the tariff side of things. And then the other issue is, as we progress into September, what does Apple do from a pricing perspective? If we were to see higher tariffs from this 232 semiconductor investigation. Our belief is they're going to look to offset that. So you're probably going to see some sort of pricing hike if you see these higher tariffs. So our view is they're going to try to sustain some of those margins. But again, it's tough to really know. Right now, we're pegging in about a 25% expected semiconductor tariff. And likely, some sort of $50 bump up or what have you in terms of pricing with the iPhone 17 cycle. But listen, it's very fluid in nature. We just don't know the details at this point in time. And Apple themselves, the bigger problem, doesn't know as well.
So when you think there could be price hikes, Angelo, for those new devices in the fall, have you tried to put a number on that? What kind of hike we could be looking at? Quantify it?
Yeah, I mean, like I said, we're thinking potentially, and this is important, right? When you look at Apple specifically, they haven't increased the base price of their iPhones, right, since the iPhone 12 cycle. The reason they did increase the price on the iPhone 12 cycle was because of the move to 5G. 5G has significantly higher content costs attached to it, and as a result, they were able to pass through those higher prices to the consumer. It was expected. Over the last couple of years, they've done a number of things to avoid any type of price hike. We think it's probably going to be something along the lines of, let's call it about $50 or so across the board. It could potentially be more than that again if the tariffs are higher than we anticipate. So Again, it's very uncertain in nature. But the fact that Apple historically has tried to prevent these price increases to the consumer is very important. I think also Apple wants to make sure the optics doesn't look bad with all of this, right? I mean, you've got a Trump administration at this point in time that probably is looking very closely at some of the moves that Apple as well as others are doing, whether or not they're passing on these higher costs to the consumer. So Apple wants to avoid any sort of bad optics at this point in time as well.
Hey, Josh, yeah, Amazon stock been trading on both sides of the flat line after this report came out. So I'm going to give you the high-level numbers here. Amazon reporting revenue of $167.7 billion. That was against a street estimate of $162.1 billion. So a beat on revenue there, also a beat on earnings per share. Amazon posting adjusted earnings per share of $1.68 against a street estimate of $1.32. I do want to read some other key metrics for you here, Josh. So the second quarter operating income, that came in better than expected. Amazon posting second quarter operating income of $19.17 billion, above an estimate of $17 billion. But key metric here that I think has maybe perhaps held the stock back, reading through the report, I would have thought maybe up. You take a look at the third quarter operating income guidance, pretty wide range from Amazon here. Amazon with a range of $15.5 billion to $20.5 billion for operating income. Of course, that's perhaps where maybe tariffs could come into play, right? The street was looking for an operating income in the third quarter of 19.42. So Amazon with a wide range. The low end range of that third quarter operating income is lower than what Wall Street had hoped for.
And Jeff, I want to bring you here as well because I think you hold this one. Another metric is AWS sales, of course. That's what folks are going to make a beeline for. It looks like AWS net sales ex-FX plus 17%. That is smack in line with estimates.
Wow. Okay. No, yeah, AWS is where my attention goes to all this. That's the growth engine for where Amazon's going to go. They obviously, I'm assuming we'll find out in the actual text, but with that wide range, I'm assuming they're building in some tariff concerns, especially around there on the low end.
They have also, I remember, Jeff, too, and it'll be interesting how they comment. I remember they've also talked about in the past being, on AWS specifically, being capacity constrained, and I wonder if that's another issue that'll be brought up.
Well, that's an issue with all AI, right, of capacity from a power perspective, and just getting the products here to continue to build and grow it. I expect AWS to continue to be the growth engine. They have some headwinds there, obviously, like we've touched on a little bit, but that's a great number for me. And I definitely want to dig into that forward-looking guidance of what they're worried about.
I also wonder, to the extent that, obviously, now this is the last of the cloud giants to report. We had Google, we had Microsoft, and then Azure print, which really impressed people. I think it was 39% maybe. And I wonder, I wonder if that was set some type of bar for them as well, AWS.
Yeah, it's tough if you're not the best looking girl at the dance. And that's where kind of Amazon might be coming in here, right? Next to Microsoft, it looks bad. In a vacuum of totality with Amazon, though, it's a good number, but compared to Microsoft, I can see why the street might react negatively.
What do you think, Josh?
Yeah, well, I think when you think about that Microsoft Azure number, I mean, we were talking about this on the morning show this morning, to surprise Wall Street by over 4%, like Microsoft did yesterday, they hadn't done that in over 2 years, right, for that Azure growth. So to see acceleration in that part of the business is a huge story for Microsoft, and it just sets perhaps a high bar for Amazon. And you also brought this up earlier, Jeff. I mean, the stock was already up 2% today, too, right? Yeah. So we're looking at a stock that's essentially trading almost flat over the last 24. Like, it hasn't moved a lot, and it's certainly not selling off. I think this is a company where you definitely want to hear more on the call, especially when it relates to AI and what is AI doing for AWS, right? That was a story Microsoft told very well last night on the call.
Amazon shares under pressure as its AWS growth failed to impress the street, and CEO Andy Jassy's response to analyst questions on the subject during last night's call, well, that didn't help boost investor confidence.
We have a meaningfully larger business in the AWS segment than others. I think the second player is about 65% of the size of AWS. The results over the last number of quarters, there's sometimes where as far as we can tell, we're growing faster than others, and sometimes others are growing faster than us, and it's still early. I mean, how often do you have an opportunity that's $123 billion of annual revenue run rate where you say it's still early? It's a very unusual opportunity that we're very bullish about.
Joining me now with his take on Amazon standing in the AI arms race is Brad Erickson, RBC Capital Markets equity analyst. Brad, it's good to see you. Did you find that
Thanks for having
Jassy was too, maybe not dismissive, but a little too casual about the concerns that the street's expressing? Do you think Amazon's gotten a little complacent?
Generally, yes. He had kind of a tough conference call, we'll say, or the company had kind of a tough conference call, to put it lightly. I think, they just didn't really address the fact that there is a large and frankly, this quarter, growing gap between the growth rates of AWS and particularly, Microsoft and Google. And I think, to put a sort of more particular point on it, he spoke about, other companies, mostly meaning Microsoft, benefiting from training revenue. A lot of that is intended around OpenAI, and Amazon does not have OpenAI as a customer. They have Anthropic, which is a positive force, but it's not nearly as big as what OpenAI is doing. And so what he's saying is as more developers start to use other platforms, say besides OpenAI over time, they will benefit from that. We believe that to be true. The problem is the optics of how that's sort of, outputting into their financials right now is just not great. And so that's the issue for the moment.
And I guess it's also a timing issue, right, Brad? Like, at what pace do you think that will start to happen?
That is the $1 trillion question, or what did you say, $187 billion question this morning. Yeah, I think the issue is, and the analysts that cover the stock all spoke with the company afterwards last night. They're not really giving us good indication that it's coming in the next even quarter or two. What we're looking for is acceleration, right? They grew 17.5% last night on the revenue of AWS. I think investors are looking for something probably that approaches 20% over time. We think that's probably a next year type of thing, which is fine. You can hold the stock here and play for that, but you're probably not going to get it for a little while.
And you ask in your note in reaction to the earnings whether the changes we're seeing are structural here. What would be your best guess at the answer to that?
Yeah, I mean, like a lot of things, we can make the argument both ways. Right. If we think they are having structural issues, it's just, again, that Microsoft is capturing so much of OpenAI's development, as well as those using, OpenAI's models and others that could flow through Azure, and that Amazon just isn't going to capture that as much over time. That's the negative argument. The more optimistic view is just that, hey, look, again, OpenAI has that huge lead. Everybody's aware of that. But we know that these models are going to commoditize over time. The developers are going to use a lot of different kinds of models. That's actually what the most attractive part of AWS's platform is they're going to have probably the most models, kind of a menu of models for custom use by whatever companies want to use. We think that's really compelling over time. We actually think that's how it plays out, but that's the more optimistic view.
We know what Apple earned last quarter, and we know what Amazon earned last quarter. Dan, I want to go to you on this. Let's talk Amazon first, because this is the one that is really moving more this morning, and is sort of one of these things is not like the other situation relative to its cloud peers.
Yeah, getting slapped around this morning. My goodness. The big deal here for Amazon was obviously the AWS number, and then the outlook for operating income. So they beat on the top and bottom line. It seemed like a good quarter. They barely squeaked by beating the street's estimate on AWS, though. And then their operating income for the current quarter came in lower than the midway point. So the big takeaway is they're not really making the money that Microsoft and Google are in their cloud business. Now, Andy Jassy would point out that they're a markedly larger business than Google. Absolutely fair and absolutely true that they're larger than Microsoft. Totally, for sure. But you have to look at it from the totality of Amazon itself. And so, when it comes to the AWS AI story, it just doesn't seem to be kind of working its way out at this point, as well as something like a Google or a Microsoft. Now, you could point to the fact that Microsoft has OpenAI and Microsoft has its own models that it's working on. Google has Gemini, obviously, and they have investments with Anthropic, but so does Amazon. They have investments with Anthropic. They have their own models. They bring in all the models that are available. So at this point, it just seems to be that the spending isn't lining up with the income just yet. Now, if this was, I don't know, a few quarters ago, people might have just said, okay, fine, we get it. You're still building out. But I think because of what happened with Microsoft, because of what happened with Google, because they started to take off this quarter, now people are looking at Amazon and saying, how come you guys aren't in lockstep? So it could just be that, people were jazzed about Amazon, Google and Microsoft. They see Amazon and they say, well, come on, guys, pick it up.
Yeah, it feels that way, right? Especially on a relative basis. And speaking of relative basis, Apple, I guess relative to pretty lousy expectations, did okay.
Yeah, I mean, look, they did fantastic as far as the quarter goes. Knocked it out of the park when it came to iPhone revenue. Beat expectations on that, as well as on the top and bottom line. The problem, though, seemed to be the situation with AI, right? That's going to be the conversation going forward. Wall Street wants to see Apple with a definitive AI strategy. They don't have it quite yet lined up, right? They're working behind the scenes. They say that Tim Cook said that they're investing heavily in R&D for AI. They're open to making acquisitions, but they didn't give us a full indication of when that's going to happen quite yet. They said that the more advanced Siri is coming in 2026. It was supposed to be coming this year. Obviously, there was delays. So it really is that kind of story of, show me what you've got going on as far as AI goes. And I've said this before. This is wholly a Wall Street thing at this point, where it's, investors, analysts, they want to know Apple is going to be a big part of the AI story. The consumer, I don't think they really care. I'll be honest with you. I think at this point, it's AI is going to be a part of products, but not a product in and of itself when it comes to consumers, unless it's an app like ChatGPT.
Elon Musk warned of near-term weakness for the EV maker as the company focuses its efforts on upscaling autonomous ventures.
We're in this weird transition period where we will lose a lot of incentives in the U.S. On the other hand, autonomy is most advanced and most available from a regulatory standpoint in the U.S. I mean, does that mean we could have a few rough quarters? Yeah, we probably could have a few rough quarters. I'm not saying we will, but we could.
So what does that cautious tone mean for investors? Joining me now, longtime Tesla bull, Dan Ives, Wedbush Securities Managing Director and Global Head of Technology Research.
Great
Dan,
to be here.
Great to see you. So I got to ask you, when the CEO of the company is saying something like that, is Tesla dead money for the next year? Should investors even bother to get in here?
Look, in my opinion, this is a company entering a golden age. Because when I think about the future, it's about AI, autonomous, robotics. Now look, was this a quarter that you're going to frame on a wall? No. The next few quarters, could it be soft from a delivery perspective? Of course, and Musk hit that. But to me, it's about robotaxis. It's about physical AI.
Well, it might be about all of those things, but it's not all about those things now.
Sure.
It's not going to be about it next quarter or the quarter after that or the quarter. I mean, when is it going to be about all that stuff?
Go back to 22, when Jensen's wearing the black leather jacket and you're talking about AI in 2022, the haters, right, all in hibernation mode, they all come out, and then think about AI, 23, and the rest is history. My view is that we are in a fourth industrial revolution. And I think that's why for Tesla, it's not about deliveries. Now look, I think deliveries does rebound a bit in the second half, but it's all about 25, 30 robotaxi in cities over the next year. It's about what I view as robotics in terms of Optum. And look, I think the autonomous valuation alone is $1 trillion.
But here's the thing, Dan. You and I have been talking about Tesla for a while. And I got to be honest, you always say the same thing about Tesla, no matter what the company itself says.
Sure.
Elon could do anything. Well, you've pushed back. You have criticized. Okay, to be fair, yes, but that more had to do with politics than
Sure.
But what's happening right now is not great for the company.
I agree that it's not great in terms of near-term fundamentals. I mean, you've talked about, and that's 100% true. And I could see some investors selling the stock. They feel like the next 1-2 quarters, nothing's going to be great. But to me, this is just the beginning of what's going to be an autonomous future, an AI future. And I think we will look back, me and you, 6 months, 12 months from now. You already might have been a robotaxi in New York City.
I have not.
No, I'm saying, but you might 6-12 months.
And
we will sit here.
I'd be more likely to be in a Waymo than a Tesla robotaxi, though, Dan.
So let's see. Because I believe Waymos are basically breadcrumbs relative to what
the robo-taxi opportunity is going to be for Tesla. But I'm just saying 6-12 months now, we look back in this period, this was a golden buying opportunity. I believe this is a $2 trillion market cap, but I get it. Look, they've hated Tesla the whole way through. Any issue like this transitional period going from EV to AI,
Right.
I get the sell-off.
Okay, so let me ask you this. Even if we agree, we're preparing for an autonomous future, we're preparing for an AI future, even if we agree on that, why are you so convinced that it is Tesla that is going to be such a big winner? Because it is a very competitive field out there. Any part of this you're talking about, whether you're talking about AI, whether you're talking about autonomous, whether you're talking about robots, any of it, there's a lot of other very smart people and companies working on all of it.
And it's a great point. I mean, look, my view is that first, when it comes to autonomous and it comes to like what they're building, I believe Tesla will essentially own the autonomous market. But it's also the view like Optimus, robotics, as that scales, humanoids, that's going to be a huge piece of the Tesla story. And then ultimately, I think by November, Tesla will take a big stake and it will get voted on in XAI. So my view is that this is going to be, when it comes to physical AI, one of the key players, along with Nvidia, and of course, other big tech companies, Microsoft, Meta, and everyone else is going to play. But it's a fourth industrial revolution. And I think viewing Tesla just as a car company, it's saying Scheffler is just a golfer. It's saying, LeBron's just a basketball player. I view this much different in terms of where this all heads.
You mentioned November as being another catalyst. There's something else happening in November, and that's the midterm elections, right? And as you alluded to before, sort of one of the things that you have pushed back against is Musk's involvement in politics. He says he's starting a political party, right? So is that going to be another challenge, another distraction for him?
Yeah, but since that July 4th, whatever, over a barbecue when he put that out, he really hasn't talked about it. And look, and we push back at it because my view is that you need a wartime CEO, just like what you see with Zuckerberg and Meta. And that's essentially what we see Musk starting to do. I continue to think the biggest asset for Tesla is Musk. So you're starting to see a different Musk driving the AI future. But even Trump, like let's say like last night, pushed back in terms of some of the comments, maybe from press secretary about Musk's AI ventures. That's something the government wants to shy away from. But now you see Trump backtracking on that, and I think really trying to embrace Elon in his latest tweet. So my view is that Musk is going to be a part of the AI future in the U.S., but you cannot, from a politic perspective, that is something I view as a lose-lose situation.
Do you think that Tesla has an absentee board?
I think Tesla has a board that's had minimal backbone. People can say it's a rubber stamp board, but I do think you're now getting to a point where the board's going to have to step it up. In terms of giving Musk 25% voting, right? So I think that's important in terms of the AI initiative, especially when it comes to XAI. But then also, we've said, guardrails are just some outlines in terms of like, look, here's going to be a massive compensation package. And obviously the Delaware issue is still in flux. We're going to give you a massive compensation package. These are the targets, everything that you talked about in the call. Okay, but you do these and the rest is history. But if you don't, as well as even some of the political stuff, that's something where I think the board needs to have a little more control.
Yeah, accountability.
Well, it's accountability for the first time. And also, like, I think it's the most important chapter in Tesla's history, the next 12, 18 months. And that's even why I like Alphabet, like stepping up CapEx. The point is, no one in this AI arms race could be on the outside looking in. It speaks to why we say Apple is going to need to do Perplexity. You can't be watching tech in the left lane of Ferrari going 100 miles an hour in that AI highway, being a minivan right lane 45 miles an hour.
So let's get your reaction as a shareholder. We got the stock down about, edging lowered about 0.4% in the after hours. Of course, waiting for the call. As a shareholder, Ross, give me the instant reaction analysis. What do you make of this report?
Yeah, I mean, it's garbage. I mean, it's sad and depressing to me that this is a business in decline when it should be, it's in a growing industry, but it has great products and it should be a growing business, and it's not. And now, if you take out the regulatory credits, they're cash flow negative. They're basically cash flow break even with the regulatory credits. And the regulatory credits are going down every quarter, and they're going to be gone soon. And the prices are going up on the vehicles soon. So I'm just like, man, this sucks. And when you look at Cybertruck and Model S and X, sales are down 54%. For their high-end vehicles, and their newest vehicle, which was supposed to be like this great truck, which I actually like, but they don't do anything to sell. And so there's no doubt in my mind that if they don't rectify the fact that it doesn't matter how many products you come up with, if people don't want to buy them, it's a problem, and they just don't seem to want to address that issue.
Now, bulls on this name, Ross. We've got financial analysts on. They got a buy on this one. You asked them to explain that outperform. In part, when I asked them about that core EV business and listen, it's EVs that are still driving the P&L here.
That's right.
They predict better days ahead, and they'll say, listen, look at that revamped Model Y and watch for, they say, that new affordable model on the way. It's better days ahead in 26 with those deliveries. What do you say to that argument?
I think that there's no doubt in my mind that Tesla needs an affordable, low-cost, small vehicle for the emerging markets and the United States if they're going to be competitive globally. This should have happened before robotaxi, and it didn't because Elon decided for it not to happen because it was more important for him to launch robotaxi. But there's no doubt in my mind if sales are going to improve, it's going to have to come from a new model that's lower priced. And supposedly this is happening, but if it's just a small Model Y, I just don't think you add incremental sales. You're going to lose, you're going to cannibalize more of your business. So what I'm also concerned about is even if they came out with a golden car that flew, that people wouldn't buy it because it's Elon Musk's car. And until somebody wants to address that Elon's political, not just opinions, but his actual behavior in public is just super inappropriate and turns off basically everybody now. Like, at what point is anybody going to address the elephant in the room, which is Elon? And it's like, if he wants to fix the image of himself and Tesla, that will improve sales. And so maybe in a year things get better. But if he doesn't change the way he's acting, I don't see how anything gets better.
Ross, talking about Musk, listen, there were investors, and we had them on the show, and analysts who were saying, listen, they weren't happy with his big move into politics, and they felt like, listen, he needs to get back to work full time. He needs to be focused on Tesla. Now it sounds like he is focused, he is committed. We have analysts on the street saying, listen, this is it, he's back. It's I think they use the word, it's wartime CEO now. As a shareholder, how do you feel about that? Is that is that a benefit? Is that an advantage to have a refocused Musk back in charge, back in the seat and back in charge of product?
Well, if you go backwards, this is what I've been calling for some time, that the CEO of the company should actually work at the company. And the fact that he's back is great news for Tesla, for sure. And the fact he's in wartime mode, although that sounds great, it's actually because Tesla's in a crisis. And that's actually when Elon works the best. Sadly, it takes a horrible crisis to get the best out of Elon. And so maybe we'll get that this time. I don't know how many, rabbits he can pull out of a hat, but I wouldn't bet against Elon. And I certainly have never bet against Elon in my career and would never recommend you bet against Elon. And I'm long the stock still. But it doesn't change the fact that probably the best thing you could do is work at Tesla and never tweet again and never say anything again. And in a year, I think Tesla would be fixed. But the working at Tesla is one big portion of repairing a lot of the issues Tesla has, but it doesn't change their image problem. It doesn't change the fight with Trump that he continues to stoke that will come back to haunt him for sure. And it certainly doesn't change the fact that liberals across the world absolutely hate him and look at him as the symbol of everything that's wrong. And until he wants to address that, I still think it's going to be hard for Tesla to grow.
As a shareholder, Ross, are you interested in seeing Tesla and XAI combined? Because Musk will say, listen, this is not an EV company, this is an AI company. Would such a combination make sense to you as a shareholder?
Well, I think that's what's going to end up happening, whether I like it or not, because it's really sort of Elon's grand plan to get full control of Tesla would be to have Tesla make an all-stock offer for XAI, which he majority controls. XAI should have never been started. It should have been Tesla. It should have all been inside Tesla. So the fact they've got a $100 billion company that they build outside of Tesla just to help Elon eventually regain control of Tesla, it's just, I don't know how to call it. It is what it is. That said, I think that's what ultimately will be, unless Elon really sees the value of not being in a public company environment, which I think he does see that value. So that would be the only thing that would preclude Tesla buying XAI. But, sadly, I think Tesla shareholders are going to vastly overpay for XAI, and they need the cash out of Tesla's balance sheet for XAI to grow. So I think this is going to happen, and it's just a matter of time.
I want to squeeze one last one in here, Ross. Spoke to another investor on the show. Their excitement, their enthusiasm, Ross, it's all about, for them, the robo-taxi service. Do you share that enthusiasm?
Well, I don't know about you, but every time I take a Uber or a Waymo, I'm going from A to B. What is so exciting about a business that's been around for a long time? The fact that a human isn't driving and it's a robot is nice. Like, I like Waymo a lot, and Waymo's doing a great job, and I prefer it over Uber. They really have done a great job, but does this really expand the market for ride sharing? I don't see it really. And then ride sharing as a business is already super competitive between Uber, Lyft, and now Waymo. And ride sharing doesn't work in every city. So I just don't, even in the best case scenario, this is a tough business to get in and to win when you already have robo-taxis on the road from a competitor like Google that has unlimited resources. And you can see the strain on the balance sheet right now with CapEx spending and free cash flow going down to basically zero and CapEx spending going higher and higher. That's what's going to happen with Tesla on the short term is CapEx spending goes up and up, but the revenue doesn't come for years. It took 8 years or something plus for Uber to be profitable. And, this is a long-term bet for Tesla and at best for a low margin business. So I'm not that excited about robo-taxis. I don't see what's so great about it. I get in a Waymo, it takes me from A to B, cost me $20, big deal.
Ross, always good to see you. Always great to have you on the show. Thank you, my friend. All right, taking a look now at Oracle as that company reports its first quarter results, and you can see that stock rocketing higher here in the after hours. We're up 20%. Let's get to the numbers. Q1 EPS, $1.47 versus expectations of $1.48. Q1 revenue, $14.93 billion versus $15.03 billion estimate. Q1 cloud infrastructure revenue, $3.3 billion. Here's a number, remaining performance obligations, $455 billion. That was an increase, according to the company, of 359%. Now let's get to the outlook, because that's what I think investors are cued on here and focused on. Oracle sees cloud infrastructure revenue up 77% to $18 billion in 2026. And I'm looking for commentary here from Oracle CEO Safra Katz. She is saying we signed 4 multi-billion-dollar contracts with 3 different customers in Q1. And as for the forecast, she is saying we expect Oracle Cloud Infrastructure revenue, it's going to grow 77% to $18 billion this fiscal year. And then she says it's going to increase to $32 billion, $73 billion, $114 billion, and $144 billion over the subsequent 4 years. She says Oracle is off to what she says is a brilliant start to 2026. This stock was already running hot into this print. It was up about 40% this year. You're up another 21% now in the after hours. Nancy, I got to turn to you. As a shareholder in this one, give me your take on the print.
God, I mean, you don't get this very often, Josh. Thank you. It's the largest holding in our ETF TGLR. Broadcom was yesterday. Today it's Oracle. And I think you have to think about the company as following a model that Microsoft sort of pioneered. So they went from packaged software to kind of cloud-based. And remember, Larry Ellison was vilified by the marketplace that he missed cloud computing. So for about 5 years, he took out an ad in the Wall Street Journal, bottom right-hand corner once a week, we're cloud computer. Now they've demonstrated it. And I think that as a shareholder, you saw the outlook is what's compelling. I mean, it's not the earnings report. And and it rarely has been with them in recent years. It's no longer a CapEx-like company. It's a cap-intensive company. There are rumors they don't have the balance sheet to expand the CapEx. I think they've got the backlog. So we're going to hold on. I mean, if it sold off today, we were going to buy more. But
you would have bought the dip.
We would have bought the dip because we believe in what the company's doing. And I think if you love the hyperscalers, you've got to love this. It's kind of like Broadcom's the poor man's Nvidia, Oracle's the poor man's Microsoft.
Well, let me ask you about that. When you think of the great cloud computing competition and market, and we think of investors, as you know, that Microsoft, Google, and Amazon, how does Larry and Software's company fit in there?
Well, they're partnering with these companies. And then if you think about law of big numbers, poor Microsoft's only growing Azure at 30% a year. I mean, you saw these numbers. This is what's going to drive the stock price into the future. And they pay a dividend and they grow the dividend. So I've owned the company for almost 40 years, and it always paid to own it when Larry was off of the America's Cup sailboat and in the CEO suite. And he's engaged. He's the chief technology officer. So I love it. I'm going to continue to hold it. We're very happy.
That stock's surging 20% in the after hours. Good news for Nancy. Good news for Nancy's clients.
And let's zoom in on Oracle now, because it is surging after giving that robust forecast for its cloud infrastructure business, expecting cloud infrastructure revenue to grow 77% this fiscal year. Joining me now is Jackson Ader, KeyBank Capital Markets Managing Director and Equity Research Analyst, and Anurag Rana, Bloomberg Intelligence Analyst. Guys, it's great to see you. Thanks for being here.
Thanks for having us.
Jackson, I want to start with you because, again, the size of a company like Oracle, having a move like this is fairly unusual. Fairly unusual to hear the size of forecasts that we got from Oracle as well. Is this sort of an Nvidia moment for Oracle?
An Nvidia moment for Oracle. Not sure about an Nvidia moment for Oracle, but I do think that we need to put not just the stock movement into perspective, but also the actual contractual fundamentals into perspective. Yeah, it's up 40%. That's a ton. It's adding hundreds of billions of dollars of market cap in a single day. But they booked in the last 90 days, or I guess, the 90 days ended last quarter, about 10% more than they had booked in business over the previous 4 full fiscal years. So it is a big stock movement, but it was also a massive bookings quarter, the likes that we have not seen, not just from Oracle, but from any other software vendors.
I guess that's what I mean in terms of it being an Nvidia moment. In other words, this is a company that's been around for a long time. We all know the name Oracle, but to see it put up these kinds of forecast numbers, as you point out, in terms of the backlog, in terms of the bookings, for a business that is pretty well known and understood, at least we thought, is surprising, right? So Anurag, how are you thinking about this? And did it feel like it came out of left field when we knew they were building this business?
Yeah, we knew they were building this business, but to get this size of an order so early on, I mean, I think that is really impressive, largely because there are so many companies out there that don't want to do it in-house. In fact, they don't have the capital to do it in-house. So they are looking for hyperscale cloud providers to help them out. We're not seeing that same backlog growing for Amazon, for example, but Oracle is getting the same chips as, one would argue some of the neo clouds are at this point. So they are in the business of renting out their GPUs, bare metal computing, and I think that's really where a lot of the traction is for people who want to train their models or they want to host their AI applications.
And I guess I want to get to that a little bit in terms of the competition here. Obviously, it's a very competitive field. There's a lot of demand for this type of compute and this type of infrastructure. Jackson, why is Oracle proving itself to be competitive here, versus some of those other names that we watch within the hyperscalers?
I think there are 2 reasons for this. Number one is a relentless focus on performance, and performance, just a fancy word for speed. And speed in the cloud means lower costs. So I think Larry said on the call last night, if not last night on some other earnings calls, that if they are twice as fast, that means they are half the cost of their competitors. And so this relentless focus on performance is certainly a competitive advantage. The other thing is, you mentioned, Oracle's 50 years old, but their Oracle Cloud Infrastructure, the OCI business, is not 50 years old.
Right.
So this business, and specifically the business that they are building, focusing on GPUs and artificial intelligence training and inference, they are a relatively new competitor. And so in this case, they almost have the benefit of being a disruptor, whereas their competitors like Microsoft or Amazon or Google, they have this, what I call Cloud 1.0, or a CPU-based cloud offering that they also have to manage. And Oracle is basically allowed to go all in on GPUs and AI in a way that their competitors just can't.
And to such an extent, Anurag, I saw a note that you all put out this morning where you posited that Oracle's book of business here could actually end up being larger than Google's.
It's possible down the road, but that's again several years out. You can't take Google's cloud for granted. Frankly, they have extremely high capabilities with their TPUs, as well as a massive install base of applications. So, but at the end of the day, this is going to be whoever gains more market share over the next several years. There is no shortage of demand right now. The big question is, do you have the capital to expand data centers at a pace that can keep up with the next competitor? And who's going to get more Nvidia chips right now? I think there's a lot of you could say fight going on those fronts.
And Anurag, when you hear that Safra Catz forecast, where they talk about the cloud infrastructure revenue up 77% this year to $18 billion, and then she talks about $32 billion next year, and then $73 billion, and then $144 billion. Do those numbers sound credible and realistically achievable to you?
No, it's possible. At the end of the day, if OpenAI keeps on spending that level of money over the next 5 years, it is possible. However, a lot depends on what is the size of, training funding going on the overall space for the next several years. There is a chance that, it's possible that we may not see that level of funding. But as of now, where we are standing, we don't see any sign of slowdown in AI infrastructure demand. Look at the results from CodeWeave or Microsoft. I mean, there is absolutely no shortage at this point.
Jackson, and I want to pick up on that point because, we keep sort of going through these AI sentiment mini cycles, if you will, right? Especially when you're talking about different industries, software key among them, right? Where I think the market has really gone back and forth questioning the utility and monetization opportunity of AI for software companies. So do you think that this is going to be a sustainable, something that's going to benefit Oracle over the longer run?
I do think that this is something that's going to benefit Oracle in the longer run. If we think about the forecast that they put out over the next 4 or 5 years, I mean, remember that the bookings or the remaining performance obligation, that's contracted. Now, contracts can always be amended, but it's not as if they are putting these forecasts out without the backlog sitting on just off their balance sheet is what I would say. So that gives you a little bit of comfort in what they're actually forecasting. Now, in terms of the headwinds that potentially come from artificial intelligence, those headwinds are expected to be felt by application companies. Oracle is in an interesting position, similar to Microsoft, where yes, they are a cloud infrastructure provider and should benefit from the building and inference of AI models, but they also might be under threat from the application side if AI were to collapse the software application market into almost onto itself. But Oracle has been pretty straightforward about, look, we are going to develop AI and agents and embed them into our applications, and we expect our applications to be enhanced by AI, and our products are going to be better than our competitors. And so our application business, as well as our cloud infrastructure business, should benefit from this AI wave.
Second quarter results for AMD, they are just hitting the wire right now, so let's get you those numbers. AMD, Q2, adjusted EPS, 48 cents. Street was at 49 cents. Top line, though, Q2 revenue comes in at $7.69 billion. The Street is at $7.43 billion. Let's turn ahead. Let's look for what they're calling for Q3. AMD sees Q3 revenue between $8.4 to $9 billion. The street was at $8.37 billion. And I'm just looking at shares right now to see the immediate reaction. Up a bit in the after hours here. No, now we're actually popping more than 2%. And keep in mind, this stock had a nice run into this print. It was up about 45% year to date. Analysts would chalk that up to different reasons. They'll talk about China AI returning. They were talking about how the core business did seem to be doing just fine, they said. And at least initially here, we see a positive reaction of about 1.2% in the after hours.
AMD CEO Lisa Su said they didn't include any revenue for the MI308 chip in the third quarter guidance. That's the one that goes into China because the licenses are still under review. And this coming after Nvidia said last month that the U.S. would be granting licenses to ship AI chips to China. My panelists, Dan Halley, Kimberly Forrest, still with me. Dan, when you looked through the earnings, and you sort of were figuring out what your takeaways were, does the China stuff sort of overshadow what seemed like a good quarter?
Yeah, I mean, that's really kind of what hurt the operating income, right? Why they saw that operating loss for the quarter. I think one of the other issues just being that the PC side, the gaming side, seemed to do rather well, while the AI side, the data center side, just kind of met expectations. So I think, when it comes to a company like AMD, a lot of investors want it to be the next Nvidia, and it just doesn't appear to be doing that at this moment. But they do have their MI355, MI350. Those are coming. Those are to compete with Nvidia's Blackwell chips. And then obviously we have the MI400s coming. Those would also compete with Nvidia's higher end chips, the Vera Rubin, in the future. And so I think that's really kind of the biggest issue here is I was reading some of Bernstein's notes this morning, basically saying that, look, the outlook for data center doesn't really impress the street when, they're anticipating the kind of explosive growth that they saw out of Nvidia. But, Nvidia is the leader in this space. AMD is trying to catch up. They also, while doing that, have to convince customers that they should buy their chips, not just Nvidia's.
Right, definitely. So that's sort of the underlying story here. And this brings me back to a comment I read this morning, Kim, from Jordan Klein over at Mizuho, who tracks the tech stocks. And he said, who really owns AMD or Nvidia just due to upside from sales back into China that had been blocked by Trump. He's saying that's not really the story here. So is that how you feel about AMD too? And sort of how much room do they have in that data center business?
Sure. Well, I think that they have a lot of room. And yeah, it would be nice for them to be able to sell chips today. But if you're owning a stock, and we own them for 3 to 5 years, so we have a longer term view, our view is that AMD is the closest thing to be able to compete against that Blackwell chip. Now, they have a couple of really important hurdles to get over. The first is just basic data center hygiene. Data center managers like to have everything uniform and the same because things are always breaking. They have to be able to understand, the parameters of the chip. What does it look like when it's going to break? How can we whip that board out, slide a new one in, and get on with our job? So that is the first hurdle. The second hurdle is NVIDIA's name brand. In my note that I wrote earlier today, this really, to me, feels like the .com era, where any kind of goofy idea could get funded as a .com if they had two things. If they specified Oracle was their database and Sun Microsystems was the servers that they were going to run on it, because that tech stack looked like you knew what you were doing. And in today's funding world, I am sure nobody's out there saying, hey, we're going to give a whirl with these AMD chips because they're probably as good and cheaper, and that's good. I'm sure every new AI idea is specifying the NVIDIA as part of its tech stack. So these are the things that AMD has to overcome. But I think they can because of their product knowledge, and they have financial latitude to, last as long as it takes to kind of chip away at that market.
So, Kim, all of that said, do you want to own AMD over NVIDIA, or you still got to own both of them?
I think you have to own both. NVIDIA's today, and AMD has the potential for tomorrow.
Turning now to Palantir, as the company's second quarter results are just hitting the wire. Let's get right to it. Palantir reporting EPS 16 cents versus street expectations of 14 cents. Revenue up 48%, $1.004 billion. Street was looking for $939.25 million. So you have beats there on the top and the bottom. U.S. government, $426 million. That's a beat. U.S. commercial, $306 million. That is a beat. Turning to the outlook, Q3 outlook, they are looking for adjusted operating income, calling for between $493 and $497 million. That's better than expected. Revenue, they're calling for between $1.083 and $1.087 billion. That is also better than expected. For the year, raising guidance here for adjusted operating income, now looking for between $1.912 and $1.920 billion, better than expected. Revenue, they are now calling for between $4.142 and $4.150 billion, also better than expected. I did have the chance to speak with Palantir CEO Alex Karp about the quarter, about some larger trends and issues. Let me bring you those comments. On the results themselves, I asked Karp for his review of how the business is doing. Karp telling me this quarter is a once in a multi-generational quarter. There is no one in software even remotely close to those numbers at our scale. And then you could ask, well, how are they getting these numbers? Karp saying, we're getting these numbers in a way no one else has done, our way, which is the combination of forward deployed engineers, ontology, and large language models at the most important commercial and government clients across the globe, especially in the US. I also asked Karp about that broader AI race between US and China, and I asked him who leads in that race. And Karp telling me, I think America is in the lead in government, and we're in the lead in commercial, but we could lose the lead. We have to have an all-of-country, all-in effort to keep America first, or we will lose. It's not a given that we win just because we're ahead. In fact, being so far ahead is often a danger zone. And finally, I just asked Karp really about the remarkable performance in this stock. Keep in mind, heading into this print, this stock was up about 100% this year. It was up around 560% over the past 12 months. I just asked Karp how he thinks about that. Does he think about that? Karp telling me, it's very hard to figure out how would you value a company with our financials. There hasn't been a company like this ever. You know what I'm thinking about, Karp said? How can we 10x our revenue in the next 5 years and make us even stronger and better? Palantir's results are out. What do you make of this report?
It's a blowout across the board. I mean, look, that's why they're the Messi of AI, right? I mean, it just speaks to this is transformational, the type of growth they're seeing. And you combine that with what we saw last week from the hyperscalers, that just shows this AI revolution. It's just starting in terms of the next stage of growth. Huge, huge step forward for Palantir.
Karp telling me, Dan, Alex Karp, CEO, told me there is no one in software even remotely close to the numbers at our scale, he was saying. Listen, you cover a lot of tech names, you cover a lot of software names. Do you agree with that?
There's nowhere close. I mean, if you look what they're doing, I mean, look, I've covered tech 25 years. This is unprecedented territory. It speaks to our view. It's $1 trillion market cap in the next 2 to 3 years. I mean, they are, look, godfather of AI, Jensen, Nvidia. Microsoft, you look at Alpha, you look at, obviously everyone that we see in terms of big tech. Palantir's right there.
Let me ask you, Dan, heading into this print, this stock was up 560% over the past 12 months, okay? Just a rocket ship. And there are some analysts on the street, Dan, smart guys like yourself, who've been doing this a long time like yourself, who will say, listen, I like the company, I like the tech, the fundamentals look solid. But they don't recommend the stock to clients, Dan. You've seen this because it's the valuation. They'll call it, in their words, an irrational valuation. What is your response to that?
They hate it at 15, despise it at 50, screaming from the mountaintops at 100, and I think at 200 they'll be doing the same. Look, Josh, we've talked about it. If you focus just on valuation over the next year, you've missed every transformational tech stock the last 20 years. And Palantir, I put in the same category.
Let me ask you, Dan, if it's not valuation then, and you're bulled up on Palantir, you've been right for a long time on this name, but the clients must ask you, Dan, okay, it's not valuation, what are the downside risks that I need to consider? Would it be competition, Dan? Is it product fit? What would the risk be?
Look, you could say valuation, macro, those are obviously, other issues that we could see come through. But the reality is that it's still early days in terms of where they're going. I mean, my view, they're basically creating a whole nother business in terms of the commercial business. Then you look on government, they're gaining more and more share on government. It's kind of a 1-2 punch. I think Karp's just playing a different game, right? I mean, I think he understands on par with Jensen and Nadella in terms of where this is all heading.
I see some analysts on the street, Dan, they do their checks with retail investors on this name, and they say they hear more interest about two issues with Palantir. They're hearing chatter, more interest in potential stock split and capital return. And I'm just curious what you make of those dynamics.
Capital return, I don't think is much of an issue because you're at the end of the day, you're focused more on this is growth mode. In terms of stock split, look, I think that could clearly happen, right? I mean, just given what we see, especially today and where this is going forward. And they are in a massive position of strength. And it goes back to like the last few years institutionally, this has been one of the most hated names I've covered in 25 years, but they just continue to execute. And I put in a rare category, almost a Mount Rushmore in terms of where I see them going.
In terms of the rare category, Dan, though, as you try to look across the competitive landscape, who would you consider competition? Who would you consider rivals or even potential rivals down the line?
Look, Snowflake's competition, you could argue Oracle, Microsoft competition, but to some extent they're partnering with them. Look, there will be competitors. This is not, I mean, they're not the only game in town, but they're just miles ahead from a technology perspective and what I hear from customers.
What do you hear from customers when you ask them? What do they tell you?
So unlike anything they've ever seen in terms of use cases and what Palantir can do relative to a lot of these other companies. And remember, they hardly basically have a direct sales force. I mean, that actually just makes this that much more pretty unbelievable in terms of these numbers.
How much credit, Dan, at the end of the day, do you give the C-suite here? Do you give to Karp?
It's gold standard. I mean, what Karp's done is it's a Hall of Fame performance. I think if you look what he's done, how he's built this company.
Do you see any evidence of these numbers? I mean, listen, I just see a lot of beats across the board. Do you see any evidence of these numbers, Dan, of any kind of macro or even downstream tariff-related impact?
I mean, look, these are numbers. Of course, you always, could they have beaten by more? Could they have raised? I mean, John, these are day plus quarter. I mean, in terms of what the street was expecting, beyond bull case. So there's nothing here that makes you any less, but you're more bullish relative to the numbers.
Intel just crossing the wires here. Let's get to those numbers. It looks like Intel Q2 adjusted loss per share of 10 cents. It looks like the estimate was more like EPS of 1.1 cent. I'm looking for the revenue number. Q2 revenue, 12.86 billion. The street was at 11.88 billion. Looking ahead, let's see what they have to say for guidance. Q3 revenue, they're calling for between 12.6 billion to 13.6 billion. The street was more along the lines of 12.64 billion. Looking for CapEx guidance, expects CapEx to be lower in 2026. They say 2025 CapEx, they're calling for about 18 billion. Do have some headcount news as well. It looks like they're aiming for headcount of 70,000 by year end. Job reduction actions total, it says here, 15%. Looking at the immediate reaction in the stock, Adam Johnson, we're up around 4% in the after hours. Interestingly, you used to own this name.
I
you
did.
were in Intel, then you
was.
got out of Intel.
Yep.
How come?
It's too hard. And I don't think they know what they want to be. Though I will also note today's numbers are pretty good, and most notably the revenue guidance that you just mentioned, the original number was 12.6 billion, and they're saying it's actually now going to be 12.6 to 13.6. So they guided up their forward revenues. That's positive. But again, my problem is this company can't figure out, and they've literally flip-flopped several times, they can't figure out whether they want to make chips or whether they want to design chips or they want to actually do both, which is what they used to do. And so that's been the problem. They just haven't clarified their way forward. You know, I think the thing that would be most interesting is if they were to split into two and they were actually to create two separate companies, Intel Manufacturing and Intel Designs. And then we'd have clarity on both and we could set separate price metrics on each and therefore price targets on each. But right now it's a mishmash and it's kind of tough to quantify.
Yeah, to your point, the headline here so far, they did seem to offer this stronger than expected revenue forecast for the current period. I think that helps explain this pop, 5% in the after hours. Third quarter sales, 12.6 to 13.6. Analysts, looks like consensus had projected number at the low end of that range there.
And by the way, Josh, for those who are watching and say, gosh, I want to get on board, maybe I should buy some Intel. Actually, go buy some Nvidia. It's easier because if Intel is guiding up revenues, you can be sure that Nvidia is going to be guiding up revenues, and that's a more obvious way to try to participate on the upside. And Nvidia reports in a few weeks, so that would be. I don't trade numbers. I'm not. I'm a buy and hold investor. But if I were trying to benefit from this news, I would go and just buy myself a little Nvidia.
We have now Bob O'Donnell. He's president and chief analyst at Technalysis Research. Bob, Intel reports the stock is popping here in the after hours. What do you make of these results?
Well, as you guys were just discussing, look, the revenue numbers for this quarter were higher than expected. And most importantly, of course, the forecast was higher. Look, there have been challenges, and I understand the point that you guys were just discussing. Intel does, I believe, really want to be both a chip maker and a chip designer. And they really are trying to figure out that path. Look, Lip-Bu's only been in there for a quarter. The kind of changes they need to make are more than a quarter long, right? This is a multi-quarter, realistically probably multi-year kind of complete turnaround story before all the benefits start to show up. A couple interesting things.
Let me ask you, Bob,
Go ahead.
just to stop you there, because I think you're touching on an important point. And I have lots of questions on the metrics of this print, Bob, and we'll get into that. But you're touching on an important point, which I do think there is this broader question out there, Bob, about what Intel is going to be. What is the game plan here? What is the strategy, Bob? We were talking earlier to our colleague Dan Howley about this, how honestly, Bob, we really don't talk about Intel that much on the show. We talk about Nvidia, AMD, Broadcom, Micron. It feels like Intel is not in the conversation. So what is the game plan here moving forward?
Well, look, the game plan is they're going to focus obviously on x86, which let's not forget. There's still several hundred million PCs get sold every year. Lots of servers get sold every year. Intel owns the vast majority of the CPUs in those systems. And even in the Nvidia, the big stacks, up at the top of the rack, there's an Intel Xeon CPU in there. Now, as a percentage of the total BOM, it's still pretty small now, but it's still there is the point. So you're going to see them build their own products, sell their own products. You're going to see them start to try and build more products for other people. That's the foundry side of the business. The way this thing was constructed, the reason why it's been such a challenge is they were so intertwined, making for themselves versus trying to make for other people. And so now as they tear those pieces apart, it's been painful, right? Clearly, it's been a big challenge for them to try and clarify all of that. And a quick glance at the numbers, they talk about inter-segment elimination. That's, when Intel sells the stuff they make to themselves, right? They have to pull that out of the discussion. And ever since they've kind of split off the foundry business, that's been part of the situation. They're focusing clearly now on 14A, for external customers. 18A is likely going to be mostly Intel, maybe a little bit of some of the things they announced in the past, Microsoft, Amazon, I think a little bit of DoD stuff as well. But the big focus for future customers is 14A, which is still coming. So again, back to what I said earlier, I think this is still a longer term story. And in the interim, they have this difficult situation where they got to crank out as much x86 as they can, get that PC market renewed again, get themselves stronger back in the server business. They're shedding a lot of the other businesses. They just shed their automotive business. They sold off some of the Mobileye, still the majority owner in Mobileye. So they have their hands in it to some degree. But, they're focusing on their core. They're trying to figure out a better AI strategy, not with a GPU, because, Lip-Bu said, hey, look, we're not sure we can play that game. But there's a lot of AI work that's done on CPUs. A lot of it has to do with software. Intel actually is a stronger software story than a lot of people realize as well in terms of the nuts and bolts types of software that makes this stuff work.
When it comes to that PC business, Bob, I'm just curious, do you think we could be seeing, any kind of tariff-related pull in there? What do you think the trend looks like ahead? Tariff calls are impossible to make these days, honestly, Josh.
So, and there was some argument that happened this past quarter. Maybe it'll happen again next quarter. It's really hard to say. The bottom line is, people are refreshing their PCs. We are starting to see the integration of new systems with NPUs built in them. Initially we saw Qualcomm do that with their Snapdragon X Elites with an ARM processor. Now we've got Intel doing that. They've got a stronger NPU. AMD is doing that as well. Microsoft is pushing this. So I think we will start to see a bigger corporate refresh. Not to mention, oh, by the way, the end of support for Windows 10. That's a huge deal. All of these things, I think, help drive the story around a renewed PC business, which Intel still owns the majority of, and so they would get the most benefit from it. But look, it's not going to be easy. Clearly, it's going to be a longer-term story, but I think they're trying to put the pieces in place, and I feel like Lip-Bu's, got a strategy in hand, and he's trying to make it work.
Final question, Bob. Just switching gears a bit on you here. Big tech CapEx, Bob. You saw that what Alphabet just forecast, right? Wow, that was an impressive number. We'll see what Microsoft, Meta, Amazon, what they have to say. What are the chip names, Bob, that you think are poised to benefit from that trend going forward?
Well, obviously, Nvidia is going to be the biggest one, as you guys were just talking about, right? I mean, look, that's the easy bet because, all these companies are spending, they've already committed or announced these huge commitments. And the vast majority of that, of course, is going to go to Nvidia. There's going to be other folks, right? I mean, there's the memory makers, there's the Microns of the world, there's the folks who help design the chips that do that, like a Lam Research. You've got Cadence of the EDA guy. I mean, there's a big trickle down in semiconductors. There always has been. And we'll start to see all of that because we will see a lot more AI infrastructure being built. And there's a lot of potential plays there. Eventually, we get to energy, right? I mean, people are talking about small modular reactors and all this crazy stuff to power all this AI infrastructure. So, I think there's a number of places where it goes, but clearly Nvidia and then AMD. Sorry, I should have mentioned them too as well, right? AMD is clearly the strong number two there. Intel's a smaller player there. Qualcomm's a smaller player in terms of the data center. Both are stronger in client. So lots of different places to think about it when we talk about AI for the long term.
Well, Qualcomm, third quarter earnings, they're just now crossing the wire. Company reporting a beat on the top and bottom line, but the stock is under some pressure here after hours. For more, Corey Johnson, Chief Market Strategist at Epistrophe Capital Research and host of the Drill Down podcast. Corey, it is always great to see you. Let's start, Corey, with Qualcomm. It looks like we have some initial disappointment in the after hours, my friend. Stock is down about 4%, but what do you make of the results? Walk us through the report.
The results aren't bad here. I mean, we saw some real progress across a lot of product lines. Of course, the concern with Qualcomm is always going to be in mobile phones, but as they grow out this business to be in other places, they're showing some real strength here. So, in particular, their Snapdragon 8 Elite showing up in some Samsung foldable phones. It's a really hot product category right now. It's kind of top of the line out of Samsung, and they're having great success there with the Snapdragon 8 Elite. They've also showed some really strong growth, throughout their other acquisitions into data centers. There was a company that they bought called AlphaWave, and AlphaWave has seemed to really help them in terms of getting into the data center and expanding their business beyond the mobile phone market. Now, the mobile phone market has been tough for the last year or so, but I think it was generally a pretty good print for Qualcomm.
How would you expect, Corey, on the call that execs try to sort of frame the tariff issue and resulting impact to demand for devices that contain their chips?
Yeah, so one of the most interesting things going on with Qualcomm right now is their automotive business. It's nearly $1 billion. They reported $84 million, I should say, in the quarter. That's up 21% year over year, which is so much more than the growth in automotive sales in any geography. And so what you see happening for Qualcomm is what's happening in the automotive industry, which is lots more silicon in every single vehicle, such that it's a very big business for companies like Qualcomm. But you wonder what's going to happen because tariffs hitting so hard on the automakers are likely to hit them so hard, and that we might get some clues about that as it relates to the orders of semiconductors. So it's not just tech nerds like you and me digging into these calls. It's a lot of the overall industry, overall economy is going to be listening to what's happening with Qualcomm because it's going to tell us a lot, not just about tech, but about what's also happening in the automotive sector.
You ask a broader question, Corey, which is about platform independence and why that's a risk for chip makers. Walk us through that.
Well, I think fundamentally, the chip companies want to get, and no company has done this more probably arguably than Qualcomm, which is not only do they get sort of attached to the socket, the space in the phone is their space to lose, they can't lose it, and that they want to have a very unique offering that only they can solve that problem. Problem is, of course, the phone makers don't want that, and consumers might not want that. They want to be able to kind of move services from device to device, and of course, lower prices because you've got lots of competitors there, and that's the kind of real battle going on with Qualcomm and so many others.
I want to switch gears to another name reporting, ARM. Now that one, in the after hours here, Corey, we see that stock down, looks like about 7% right now. What do you make of that report?
Look, it's a really expensive stock. It's a fantastic business model because it's the royalty business, which grew at 25% in the quarter they just reported in the last hour, was really strong in terms of growth, but it's got to be to support this kind of valuation. They had some great success in the data center. They talked about having over 70,000 customers in their ARM Neoverse chips, up 40% on a year-over-year basis. Those are chips that go into the data center and are kind of attached to the devices being built by the hyperscalers, so Google and Microsoft and others, developing around, yes, Nvidia, but also connecting right there with ARM. And so that's so important for them going forward. We're going to listen to the conference call to hear what we know about data center growth, because a lot of other places we hear just fantastic numbers. We look at the CapEx numbers you guys were just talking about from Microsoft, how much they are spending there. We're at a point now, as of the reports of the last hour, where the biggest companies in technology, Amazon, Microsoft, Google or Alphabet, and are spending $1 billion every day into the build out of AI. They're just kind of amazing numbers to behold. And the question is how much of that is going to show up for companies like ARM and Nvidia and others. There was a company that I own, so I pay so much more attention to it than others, called Comfort Systems. It's an HVAC company. They make the electrical repair and HVAC repair, but they've got such a big data center business that the stock is trading at all-time highs. They're growing in ways that they never have. You see this, how important this is to the overall economy, the AI build-out. I think that's why these names are getting so much attention, maybe more attention than enterprise technology has received in 20 years.
Last question, Corey. On ARM, if I'm in that name, what in your opinion would be the risks that should be front and center that I need to consider? Is it the exposure to China, Corey? Is it competition? Is it just the semi-cyclicality? How do you think through it?
I think a lot of the things built into this name in particular is the notion that we're going to have edge AI, that we're going to have AI in all of our devices really, really soon. And if that happens, that'll be great for ARM and great for Qualcomm as well. If that doesn't happen soon, if we're still talking about building foundational models and the focus of AI a year or two from now is still the data center, that's not great news for ARM because ARM wants it to be everywhere. I think we'll always, or at least for the next decade or more, still be building out large language models, still be doing foundational work in AI, but it will have proliferated out to the edge. We'll be using AI in so many more things and in things we can't imagine right now. That's where the ultimate big growth is for ARM, and we're certainly not there yet.
Corey, always love having you on the show. Thank you, my friend.
Buddy.
Taiwan Semiconductor raised its full-year guidance as it anticipates sales growth of about 30%. That's after a better-than-expected 61% jump in sales in the second quarter. It seems to show that hyperscalers remain committed to aggressive expansion into artificial intelligence spending. Joining me now, Paul Meeks, 17 Asset Management CIO and Water Tower Research Managing Director. Paul, it's great to see you. So we had TSM here coming out in contrast with ASML, which is a chip equipment maker, coming out yesterday and seeming to express that its clients are uncertain about orders because of the pace of tariffs. Then you get TSM today. So how are you thinking about the two in comparison with each other?
Well, they're both great companies, and they're both absolutely necessary in the semiconductor supply chain worldwide. I will tell you, though, Taiwan Semiconductor, being a foundry and not a capital equipment maker like ASML, does have advantages. The manufacturing, essentially for all the US-made designs, is something that will always put them first and foremost. Now, over time, I imagine that if Taiwan Semiconductor keeps up its pace, it is going to have to order at some point, probably not in the near term, but we'll have to order some extreme ultraviolet equipment from ASM. So they are at least somewhat drawn together. But I would not put them in the same camp. ASM is obviously telling us that they are uncertain about the look, not for 2025, but their outlook for 2026. But I expect no surprises and further upside, at least on revenue, from Taiwan Semi.
And when we look at Taiwan Semi, is what we heard from them today a signal to sort of about the broader chip industry, given that they still seem pretty optimistic?
Oh, for sure. And particularly the voracious demand for high-end computing, and particularly for their wafer designs under 7 nanometer, which is the length of the transistors. I will tell you that nobody else can do it. And Samsung, which was up until now the world's #2 foundry, has had some stumbles of late, particularly with their AI memory chips. So there is no company more important than Taiwan Semi on the planet. The only thing that I worry about with Taiwan Semi, it's not their fundamentals. It's this dude in China named Xi Jinping. And does the mainland Chinese ever decide to take Taiwan? But we'll see about that.
Yeah, we will see about that. I mean, is that something, when you're owning that stock, is that something that you need to sort of hedge against in some way?
I don't know if you can hedge against it, but it's obviously something that you have to consider.
Right, for
Right,
sure.
Xi Jinping may have the job for life. He's still a relatively young man, and he stated on many public occasions that before he steps down for power, he would like to retake Taiwan. So yeah, that's kind of scary.
Salesforce, that company's second quarter results just hitting the wire. You can see they were down about 1% initially. Let's get the results. Q2 adjusted EPS, I see $2.91. I don't see a clean compare there. For Q2 revenue, $10.24 billion. That's up 9.8% year over year. It looks like Q2 operating margins, 34.3%. Street was expecting 33.8%. Now let's turn, though, to what does Mark Benioff's company see in the forecast, the guidance, Q3 adjusted EPS. They're calling for 284 to 286. The estimate was 284. The Q3 revenue, they're calling for between 10.24 and 10.29 billion. The street was at 10.29 billion. So maybe that explains a bit of the initial disappointment there. I'm just looking for the full year as well. I see full year revenue. They're looking for 41.1 billion to 41.3 billion. They had seen 41 to 41.3 billion. Keep in mind this stock, Lou, it's already had kind of a rough move. I mean, heading into this print, we were down about 25% year to date.
Yeah, the narrative has been that AI is going to eat software, right? And then we got a counter narrative to that last week when MongoDB reported results and rallied 20+% after hours. I think you're right. I think looking quickly, first blush at these numbers, it's the guidance not really being great moving forward.
The Q3 revenue at the midpoint,
you've got to demonstrate, like Alphabet had to do 2 quarters ago, and show that, hey, in an age of AI, we're still going to be relevant. And you're seeing across the tech sector, though, cuts in terms of employee layoffs because productivity is going up. How does that translate into the software sector, and is it really a threat, AI, to their underlying business?
Yeah, I do have estimates now. For Q2 adjusted EPS, they report 291. Street was at 278. Q2 revenue 10.24 billion. The Street was at 10.14 billion. But again, it's that guidance I think investors are focused on. If I told you, Lou, I want to assemble an AI portfolio, you'd probably put Nvidia in there, right? Maybe you put AMD. Would you put Mark Benioff's company in there? Would you put Salesforce in there?
I think you don't bet against them. I think you have to have it's adapt to AI or die, a type of approach. And these are proven innovators that have navigated dynamic market conditions before. I would put Apple in there, right? The narrative against Apple is that they don't have a solution for AI. Guess what? I think that Tim Cook figures it out in time. Could it come with a partnership with Alphabet? Maybe, but I wouldn't bet against these bigger names that have a lot of resources to deploy to their advantage to win in this game.
For a closer look now at the latest quarterly results from Salesforce, we got Jefferies Senior Analyst Brent Till. Brent, always good to see you. So Salesforce reports the stock, and at least initially here, Brent, we're down about nearly 4% in the after hours, but let's hear your take on the print, Brent. What'd you make of it?
I mean, it was in line. It wasn't
better than expected, and you need better than expected when the AI narrative right now is that it's going to eat all applications. So, don't hate the player, hate the game. The game right now is you got to get north of 10% constant currency backlog, and they hit 10%. Half their customers in Agentforce are paying. It's not having a material driver for growth, and they're guiding, to high single-digit growth. And so, if you look at every large cap software name in our coverage universe, Salesforce is the slowest growing of them all.
Brett, Salesforce does have AI products, and I'm sure if Mark Benioff was here with us on set, he'd tell us all about them. Is the problem here that they're just not compelling right now, as compelling as investors hope they would be for customers?
I mean, they're in their infancy. We've talked about AI and applications versus AI and infrastructure. I mean, all the attention's in infrastructure. Microsoft, Oracle, Nvidia, go through the list, right? Where are all the numbers inflecting? In infrastructure, what happened here? No inflection. So, look, everyone has an AI story, but like the reality is the actual impact has been not material to the revenue yet. It will be for Salesforce as we go into next year and the year after, but we're talking about years. We're not talking quarters until it's material. And that's the challenge. Again, when you see inflections in Azure inside Microsoft, you see Oracle's backlog at 100% growth. We're talking 10% constant currency backlog. Like, just to put this in perspective, Snowflake's growing 30, right? We can go through all the lists, like all the numbers relative to its peers, they are underperforming. So yeah, Brett, it's not bad. It's not bad. Like, no one's going to say these are bad numbers. We're just playing a relative game where everyone else in a relative basis, Josh, are way better. And that's why you're seeing Microsoft stock up, Oracle stock up, all these other stocks are down. The reason why Salesforce stock is down 20+% is that there is no inflection. There's a worry that Benioff's going to go out and do a lot of M&A, and there's been no inflection in the numbers. I mean, again, we're talking the slowest growing large cap name. Oracle's going to grow faster than Salesforce. So we're not negative Nellies. We're just, the point is, like, when you put it relative, they're the slowest moving vessel in software right now.
And Brent, correct me if I'm wrong, though, you do have a buy on Salesforce. Explain that to us.
Valuation's at a 10-year low, and we think that Agentforce will build. We think that they can sustain, again, pretty good numbers. And again, there's no breakout play here, and so I'm trying to articulate the good and the bad and just play the ball where it lies. So the point of this is that I think when you have the most hated name in my coverage, you have a valuation at almost a 10-year low, and we think they're doing the right things, and we think that Agentforce will have a bigger impact over the next year. Again, this is more of a valuation buy than an inflection buy. There's way more companies that are inflecting that we like more, and we've highlighted those. Microsoft, Snowflake, Intuit, you go through the list. There are relatively higher rankings in terms of where we would put money to work. But again, I think you look at this, and if you have a longer term lens, this stock was actually above where it is today, where it is right now when they launched Agentforce. Agentforce propelled the stock, from 250 to 350, and it's given it all back now. And so I think a lot of the expectations are out of the stock.
Brent, what do you mean? Talking about acquisitions, what did you make of that $8 billion acquisition in Informatica? I mean, in your opinion, smart move financially and strategically?
Yeah, they were going to do it last year. They saved $2 billion, so they got it cheaper than they did last year. So this isn't like it's new on their radar. They've been trying to buy this for a while. So they saved $2 billion. Second, we know in the age of AI, you need clean data. You need the right data, and you have to put the data in the right spot. Informatica helps them. They already have MuleSoft. You've got Informatica. This should help them, with this AI journey. And we think, again, I think the thing that's worrying investors is, they went through a period where they expanded margins, didn't do M&A, and the stock did really well, and they showed organic innovation with the Agentforce. Now the worry is, with the new CFO in place that came in recently, Benioff back to doing deals, like
are we kind of back to the old Salesforce way where we've got to get growth via acquisitions? And he's done 3 deals in the last month. Tiny, smaller deals, not the size of Informatica, but he's doing more deals. So I think there's all kinds of signals right now where it's a relative bet, Josh. Everyone relatively in software is betting on other names. The hedge funds are short Salesforce, they're short every application name. Salesforce's underperformance is not unique. Workday's down. You go through the list. Any horizontal software company, Adobe down, they're all down because investors right now, it's deja vu. 2024, what worked? Nvidia, Microsoft, all the infrastructure names. What's working in 25? All the infrastructure names, because AI has not taken off yet. We're getting ready for AI. And so is the Salesforce portfolio in a better spot for when it comes to the application layer? Yes. Has it taken off? No.
So AI not taken off yet. I meant to ask you, Brent, about this MIT study, which I'm sure you saw, and I thought, you know what? I bet Brent has thoughts about this.
Never heard of it.
Yeah, I'm sure. 95% of organizations, Brent, studied, 0 return on their AI investment. I'm sure, Brent, some people saw that and they thought, okay, our absolute worst fears about all this AI investment, there it is. What did you think of that?
So I think it's thoughtful work, and I think it's real work, in that it matches what we're hearing. Some of the best data companies in the world, Databricks, Snowflake, all the best AI companies we talk to in the enterprise, not consumer AI, not Perplexity or ChatGPT or OpenAI, right? Enterprise, this is matching what we're seeing. Less than 5% of the software industry's revenue is from AI. We know all the AI products do great backflips during the demos, but when you put it in live production, it can barely tie its own shoelace. Wait, so we've seen this even in our own deployment and a lot of other enterprises' deployment of AI. It's slow. It takes time. You got to get data security right. You got to get data flow right. You got to have the right integration. You have to have the right training. You got to pull people away from their jobs to do the training. We're internally at our firm going through all the same challenges every other firm. So a 5% success rate, 95% fail rate, I think may seem high to most, but any new technology shift, it doesn't happen overnight. It takes time. But the survey of the CIOs is that rate, they're committed to improving. Everyone's trying every AI tool. Right now we're in an AI bake-off. Literally it's like going to, your fourth graders cupcake festival. Like you try all the cupcakes, then you bet on which one works. And right now, like everyone's trying everything, and we have AI fatigue. So now what's happening is everyone's like, hey, time out. I got to take a break, digest what I got, and figure out what's going to work. So we are in that digestion phase. It's going to take time. So I've said this, I'm very bullish in AI long term, but I might be the most bearish analyst on enterprise AI because right now, everything that Wall Street wants to happen isn't happening. And we've said this, the technology just needs time. It's like any tech shift. Like you didn't buy everything off of Amazon the day one when it came out. You didn't push everything to the cloud day one when the cloud came out, right? It takes years. It was like 6 or 7 years to get broadband penetration to a very small percentage of the households. I mean, you can go like at any tech shift. This just takes time. And so I think we're following many of the same parallels of the last shifts we've seen. And yeah, look, the market was not expecting a 5% hit rate, 95% failure. But I would say that I think what CIOs realize is they're committed. It's a long road. And again, looking up your favorite restaurant or trying to compare hotels on Perplexity is different than trying to do AI inside your enterprise. It's going to take time, but CIOs are committed. Dollars are being allocated. The technology is getting better and better day by day. And we have to give this time. But it's not a win for applications yet. It's a win for infrastructure because all these apps are going to require infrastructure. So the safer bet in AI is Microsoft, Oracle, many of the infrastructure vendors that are powering this versus the application vendors themselves.
Brent, always great to see you.